this adjustment correctly.
All right, prudent stance there from the co-founder of Freddie Karst. Always appreciate you joining us to break down the cybersecurity front. Be well, my friend.
Thanks, Zach. I appreciate it. Good to see you. Take care. Stay safe.
All right, likewise. We're going to take a break here. On the other side, digging into the way that we have seen billionaires here in this country and their net worth skyrocket during the coronavirus pandemic in amounts that pretty much exceed what governors across the country here are calling in terms of filling in the budget gaps. We'll discuss that right after the break. Welcome back to the ticker. Billionaires in this country have seen their net worths soar, despite the fact that a lot of Americans out there are hurting right now in the coronavirus pandemic. And a new report from the Institute for Policy Studies breaks down the wealth of America's some 600-odd billionaires, growing nearly $600 billion from March to June. That total is more than the sum of $500 billion that governors across the country are asking for from Congress to fill in budget shortfalls that will impact all of America. And here to break that down with us is Chuck Collins, Director of the Program on Inequality and the Common Good at the Institute for Policy Studies. And Chuck, I mean, when we look at it, we know that Jeff Bezos is the wealthiest American in this camp, but how has he maybe seen his wealth soar relative to other billionaires on that list?
Well, he's clearly one of the top. Mark Zuckerberg, Jeff Bezos, and others have seen their wealth. I would call it surge. The overall, from middle of March, the S&P, the market has been up, but there are some who are seeing their wealth go up by tens of billions. In the case of Jeff Bezos, he's almost at 160 billion now. If he hadn't gotten divorced, they'd be at about $210 billion. So it's almost defying gravity, some of these wealth gains.
Yeah, and when you talk about the wealth gains, I mean, it is just kind of amazing to think that so much of that wealth could be concentrated and be beyond what the governors of all 50 states are requesting from Congress to make up the budget shortfall. I mean, what does that say about, wealth inequality in this country?
Well, I think the extreme wealth inequality, in a way, was the pre-existing condition that we went into the pandemic. A kind of underreported number is the Federal Reserve last week reported that, $6.5 trillion in household wealth vanished during the first quarter. So that's the indicator of, sort of how is everybody else doing. So put that number next to this billionaire surge, $630 billion in 14 weeks. It just shows, here are states contracting. They're experiencing these budget shortfalls. They're not able to raise the revenue that they need to provide basic services. And just the wealth increase of our U.S. billionaire group in 14 weeks could cover the shortfalls in all 50 states. That's just how out of balance we are.
Yeah, and kind of surprising too. I mean, when we're breaking down this list, Warren Buffett, notably not on the top of it when we think about how his wealth has fared here. What do you make of that?
He had a huge wealth decline in February and March. He's finally come into the net positive. I think he's up about $4 billion on the year now, but he was, not everybody's wealth has gushed. Obviously, if you're in the oil and gas sector and others, you're seeing big declines there. Where we are seeing the gains are in technology and medical care and obviously video conferencing and the services that we're all depending on during the pandemic. But it starts to whiff of a kind of profiteering when it gets to be so high. It kind of reminds me of like during World War II when certain companies, when everybody else was making these huge sacrifices and tightening their belts, some people were grabbing more than was the sort of unseemly amounts of wealth.
Sure, and it makes you wonder what kind of push here we might see if Joe Biden comes to power here in 2020. What kind of progressive ideas there on the wealth inequality front might be pushed through? But Chuck Collins, director of the program on inequality and the common good at the Institute for Policy Studies, appreciate you taking the time to chat with us today.
Thanks, Zach, for having me.
All right, that'll do it for us here in the 1 p.m. as the Dow still trades about 2.25% lower here to wrap up the week. On the other side, we'll dig into the economic issues facing the U.S. as we see more states reverse course on reopening their economies. We'll chat that with Mark Zandi, Moody's Analytics chief economist, on the other side of the break. Stay with us.
Welcome to Yahoo Finance Live. This is the ticker. I'm Akiko Fujita, and with 2 hours left to go in the trading day today, we are seeing some steep losses across the board. The Dow is down now more than 600 points, the S&P 500 down roughly 57, and the NASDAQ down 191 points. All sectors, major sectors in the red right now. Financials seeing the steepest losses after the Fed suspended corporate buybacks and capped dividend payouts for the third quarter. Losses in the Dow certainly accelerating after Texas announced that it is rolling back its reopening plans there after they've seen a huge uptick in cases. We're going to break down what that means for that state. Meanwhile, the number of patients hospitalized hitting a record high for a 14th straight day there. Florida also seeing a huge spike. Florida case counts now up 7.8%. That is more than double their 7-day average previously. And we are seeing reports here that Florida has now reported nearly 9,000 new cases for the day, shattering a record. Some trade news also weighing on investors today after that report out from the Wall Street Journal quoting Chinese official saying, or warning, we should say, that the U.S. should not be meddling in matters that Beijing considers off limits, saying that could put the U.S.-China trade deal in jeopardy. Consumer spending, meanwhile, on the economic front, jumping a record 8.2% last month after dipping to a historic low the previous month. Analysts were expecting a bigger bounce back, though. We also did see personal income drop 4.2%. That is the most decline, or the biggest decline since January 2013. Let's bring in our first guest for the hour. We've got Jimmy Lee, who is the CEO of the Wealth Consulting Group. Jimmy, certainly a lot to go through on this Friday, but let's start with where you were going into today, because you said you expected about a 5 to 10% pullback, given how far ahead the market has run since the March lows. Given what we're hearing today on the coronavirus front and the business or the reopening pause that's now happening in multiple states, does that change your base case?
No, I still think we're going to go through maybe a 5 or 10%, like I said, pullback because the market probably got a little bit ahead of itself. And when everybody was saying that we were going to retest the lows a month or two ago, I didn't buy into that. I think too many people were on that trade. But, you know, are stocks overvalued? Not all, but did the market go up a little bit too quickly? I think so. So I think the action that we're seeing right now really has been predictable. I don't know how anybody would have expected that we're going to reopen the economy, lots of people eating in restaurants together and so forth, and not have, you know, the infection rates go up. And so until we have a vaccine, I think it's going to be touch and go. But I don't expect the economy to shut down again fully like it did. I don't think anybody does. So I still see the trend higher in stocks after we get a pullback.
What does this do to the economic recovery, though, in your view? Because to your point, you know, the performance that we've seen in the markets haven't necessarily equaled what we've seen on the economic front. Certainly things have been improving in terms of, retail numbers, even the numbers that we got today in terms of consumer spending. But as we've learned over the last several weeks, this is kind of a stop and go process. Is there a bit of a reality check that's happening today, given the news coming out of Texas?
Sure, I think there is, and really it's been the government that's buoyed the stock market with all the stimulus, and the Fed with its actions as well. And so I think people need to think about that in the long term. And yes, is it going to slow down the recovery as far as economic growth? Absolutely. There's uncertainty there for a while, but think about what the economy might look like when the virus is gone. And so I think people need to ask themselves that question: how will the stock market react? And of course, we have a lot to go through before that happens, before we get a vaccine. So while we have a touch and go on the economy opening, shutting down, state by state, that's uncertain. And so I think we're going to expect, I think you would expect a lot more volatility in the stock markets. And there are a lot of reasons for people to take some profits. So if you invested in the lows in March, you might be up a lot. And so on bad news, I would expect some profits taking and some rebalancing going into, you know, the second quarter closing here. So this is not unexpected from that perspective. But overall, I think that, you know, if you look a couple of years out, when the virus is gone, I think that the stocks, many stocks present a lot of value today.
Where are you taking profits right now?
Well, we've been rebalancing our portfolios, and what we actually did was in March, rebalanced portfolios into the equity markets. And so selling off some positions in mostly bonds to buy equities. And now as we balance today, we're actually improving some of the positions in going into some sectors that I think have more upside. And one of those, not sectors, but a theme is companies that are screened for ESG. I think that trend is, you know, not going to slow down and continue to gain momentum. And so we have a presence there, and I think those kind of companies will do well going forward.
One of the stocks seeing steep losses today is Facebook, down nearly 7%. It's the worst day since mid-March after Unilever announced that it will pause its ads, not just for Facebook, but Twitter as well, until the rest of the year, saying that it's a polarizing climate right now. You know, that begged the question, whether there's going to be some ripple effects. Now we've got reports that P&G plans to pull ads from platforms with hateful content, which, when you look at where the brands have moved, likely to include Facebook as well. How should we be looking at some of these growth stocks, especially in social media, in light of the broader conversation that's happening on race, but also this increased scrutiny on these platforms going into the November election?
I'm not a stock analyst, but I think Facebook will be fine. And I'm sure they'll react accordingly based on what they need to do. Of course, this is big news in the short term, but Facebook, I'm sure, will make the decisions that it has to do well going forward. And with all the news about companies going more online and closing down their retail stores, it's going to just boost Facebook and other companies' opportunities to sell online. So I think it's going to be a short-term thing. I think they'll do fine. But our firm, we're not chasing the high-growth tech names that are trading at incredible multiples. I think investors should watch out for that. But tech, I think, as a sector overall, though, will still do well.
Okay, Jimmy Lee, the CEO of the Wealth Consulting Group. Good to talk to you today.
Thank you.
Well, let's shift our attention back to the coronavirus, because Texas is now rolling back some of its reopening plans, shutting down bars today, also limiting the capacity for restaurants down from 75% to 50% indoors. The state's also limiting the number of outdoor gatherings for more than 100 people, saying those must be approved moving forward. Lauren Sauer is an assistant professor of emergency medicine at Johns Hopkins Medicine. And Lauren, this is a huge turnabout, at least for Governor Greg Abbott there, who as recently as Monday said that any additional closures would be the last resort, the last option for the state. But here we are on this Friday talking about it. How much of the damage that we've seen so far can actually be mitigated as a result of these measures? In other words, if we've seen a huge uptick already with the virus, how much of this can now be contained as a result of the measures Texas is taking today?
I think very similar to where we were in March. We're going to see, even as those reopening activities get rolled back in some of these states, that we're going to keep seeing an upward trend. It's basically the fallout of reopening too early. And so we are going to see an uptick, sort of a trailing uptick in hospital cases and in new cases, new exposures, and a lot more contacts who are going to come down with the virus in the next couple of weeks, probably, as those activities start to get rolled back today.
We've heard from a lot of these governors about what is different, or what they see as different this time around. Some of that has to do with those who are getting the virus, those who are in their 20s and 30s, more likely to be getting it right now. When you look broadly, compared to where we were in March, what worries you most about the kind of spread that's happening right now?
I think one of the things that worries me the most is that our toolkit hasn't really changed that much to be taking these drastic reopening measures, and for these young people to be taking so much risk. So even when the states are reopening, we've still been encouraging people to be very cautious, to wear their masks or their face coverings, and to not go out any more than they really needed to. And so the fact that the reopenings meant to a lot of people go back to business as usual, go back to normal, go back to pre-COVID, that's the piece that worries me the most, that they don't fundamentally understand that there is this real risk because we don't have a vaccine. We have limited therapeutics that more or less can only be used in the hospital setting. We don't have the thing that will stop them from going to the hospital just yet.
Lauren, you said earlier that we're kind of back to where we were in March. And when you look at the measures that were put in place at the time, we were talking about a full-on shutdown of the economies in some of these epicenters. Even with the measures Texas has put in place today, we're still talking about restaurants with 50% capacity, those that are allowing for indoor dining. Here in New York City, where the numbers have gone down, that's still not part of phase 2. Are these measures enough to limit the spread at this point, or is there a need for stricter measures, the kind that we saw back in March, in order to contain what's happening in places like Texas?
Yeah, I think part of the problem is what happened in a lot of these places is it was a big reopening rather than a scale back up into those later phases. And so people really did go back to just going to restaurants, going to bars. And I think Texas is very telling because they were working on building surge capacity in the hospitals rather than reclosing bars earlier this week, you know, and so they're actively trying to get people out of the hospitals to make space, but they're still letting people into bars. So I think that we have a long way to go insofar as explaining the steps to reopening, and we're essentially going to get another opportunity because of this increase in cases that we're going to have to think about that slow roll back to reopening, that real careful phased reopening.
When you look outside of some of these epicenters, states like here in New York, Connecticut, New Jersey, saying now they're going to be quarantining those who are coming from some of these high case states. We're also hearing reports that the EU is considering a travel ban for American travelers that are heading to the region. How effective have these types of measures, or how effective were these types of measures at the height of the pandemic? And does it make sense to implement them again this time around?
Yeah, at the very beginning of the pandemic, we actually really didn't have a lot of data on how these travel bans impact spread. We just didn't have the studies, we didn't have the data to inform them. So people were making educated guesses on how you implement them. I think we have more data now to show how they work and how they can be effective. But within the country, it's really hard because we don't have real borders, right? People can drive across state lines back and forth and back and forth. People may live in one state and work in another state. And within the country, having travel bans or quarantines is not really feasible. As far as the EU banning American travelers, I mean, I think it's not unreasonable to expect that things like that will happen given the unmitigated spread within our country.
And finally, Lauren, we did get some news on the political front. The Trump administration filing a brief asking the Supreme Court to overturn the Affordable Care Act. We're not expecting a ruling until the fall, so no immediate outcome here. But I'm wondering, when you look at this, there's definitely the political element of it. But how significant is this from a coverage standpoint? I mean, what percentage of patients are you looking at potentially that could be affected if this is overturned?
Yeah, I don't know the percentage per se, but I know that a significant portion of the U.S. population relies on this as their primary means of healthcare coverage. And I think as we're also hearing the administration talk about reducing the support for things like COVID testing, and these things happening in tandem, where the financial support for the healthcare needed for this, completely overwhelming health crisis, it's really concerning, political or not, to think about reducing people's ability to access healthcare coverage in the midst of it.
Yeah, no question. A lot of patients are going to be looking to that ruling in October. Thanks so much for that, Lauren Sauer, joining us from Johns Hopkins Medicine. We are off for a quick break, but coming up, we're going to be heading out to Texas to discuss what these measures that were put in place today means for businesses operating there. A lot of those businesses had to shut down back in March. That now they're being asked to scale back their business yet again. Jeff Mosley, the CEO and president of Texas Association of Business, will be joining us after the break. with Texas Governor Greg Abbott today announcing the state will now be rolling back some of its reopening measures. A lot of Texas businesses are looking at a repeat potentially of what happened in March and having to scale back some of their operations. Let's bring in Jeff Mosley. He's the CEO and president of the Texas Association of Business. He represents about 1,500 businesses across the state. Jeff, it's good to have you on today. What are you hearing from some of your members today in light of the developments?
Well, thank you, Akiko. What a delight to be with you and with your listening audience. Of course, Texas is a very big economy. We're roughly 1/10 of the U.S. economy, so we're right at $2 trillion. And we have such a vast, diverse state that it is very challenging to find a best practice that fits everything. But we are blessed in Texas. We have a governor and a lieutenant governor that have worked very closely with business leadership to understand how to go into isolation and then how to reopen and come out of isolation. And the challenges, of course, Akiko, is that nobody's ever done this before. I mean, this is a first time for anybody living to have navigated through this. I remember my grandmother Mosley telling me about the Spanish flu hitting her village in central Texas and how devastating it was. But today, we don't have anybody around that can really share with us how to get through this. And so we're learning as we go. And the business voice has been very much a part of working alongside and supporting the governor and lieutenant governor on these best practices. So we fully embraced isolation. We said, yes, let's try that out. And then at a certain point, we felt like there was a time to reopen. But the governor's been very transparent. He said, look, let's use data and let's use medical best practices. And where the data shows that the behaviors are such that we need to go back towards isolation, we should do that. And true to his word, that's exactly how the management of COVID is happening right now in Texas.
When you look at the hospitality industry, for example, certainly one that's been biggest hit, and we're looking today at potentially a lot of these restaurants having to scale back now from 75 to 50% capacity. That's still better than how a lot of other states are operating, but how significant is the economic hit likely to be as a result of these new measures that have been put in place yet again?
Well, hospitality is a big sector in Texas. Believe it or not, we're usually number 2 as an overall tourism destination in America. And we depend heavily on those wonderful jobs that support the tourism sector. But you're right, Akiko, this is a sector that has been profoundly impacted. And so we don't see people wanting to travel as much. They don't want to go and stay in a hotel as much as they used to. They're not wanting to take an airplane and fly and travel. And so these jobs have been really hit hard, and it's probably going to take several years to get back. We are fortunate to have the ability to open a restaurant. The Texas Restaurant Association is saying, look, if you're a restaurateur, everybody has to wear a mask to come in and out of a restaurant. And they're accepting and embracing that as an association, as a best practice for the people that do enjoy eating out.
And Jeff, what are you hearing about the costs associated with staying open? We're not talking about complete closures yet. And yet we've heard business owner after business owner talk about having to juggle a 50% capacity operation while also thinking about hand sanitizers and making sure you've implemented all the cleaning measures in place as well, making sure you have the masks too. I mean, how is that cost weighing on some of the businesses that you've been speaking to?
Kiko, it's a great question that you ask. Of course, in a restaurant, those stores were designed pre-COVID. They were never designed for social distancing. So what store owners have to do is they have to adopt to takeout, or they have to also add an outdoor eating area to enhance their ability to seat guests. And it's very, very challenging to the restaurant industry. On the other hand, some of the retail people I visited with recently, they're saying, you know what, we had to let some workers go. We let 20, 25% of our workers go, but we're selling product through the digital platform, and we've actually done well financially because the demand is still there, and we don't have the overhead that we used to have because we're using a digital platform. So I think there's a mix of stories. Of course, the hospitality industry is paying the biggest price.
Okay, Jeff Mosley joining us there from Austin, the CEO and president of the Texas Association of Business. Wishing you the best of luck as you now have to juggle with this new resurgence of cases across the state. Well, some of the stay-at-home closures that we've seen over the last several months has led to a big shift to a work-at-home culture, and that could be a big boost to some companies. Julia LaRoche is here with me to talk about her conversation with Salesforce's Mark Benioff.
Hey, Akiko, that's right. Well, when you think about Mark Benioff, the CEO of Salesforce, which is the leading cloud company when it comes to customer relationship management, they have thousands of customers. So they're helping companies get back to work. And so you have to imagine someone like Mark Benioff gets a lot of questions from CEOs as to what the future of work looks like. So take a listen.
And we're in this all digital environment. Here we are, using this technology to communicate and to do this interview. And that looks a lot like what the future of work is. It's a work anywhere, live anywhere environment. It's all digital. And that's why today we're introducing Salesforce Anywhere. We've actually had to enhance and extend our own product lines to help our customers to work and live and succeed anywhere. Now, the last time we talked about work.com, which was our brand new platform that's letting our customers reopen safely. That's been a huge success. It now represents about 10% of our pipeline. It's amazing. Today, we're introducing Salesforce Anywhere, giving all of our customers the ability to work anywhere.
But do you think that this product might help us get there where it kind of becomes the normal, where you do feel like you're getting that right amount of collaboration?
Well, you're 100% right, and that's why we've integrated Zoom as well as Amazon Chime into our core platform and core services, so it makes collaboration such an effortless part of selling or servicing or marketing or conducting commerce or creating a single source of truth with your customer, what we call Customer 360. For us, the ability to know your customer and to have that deep interaction and integration with them, that is the true vision and promise of Salesforce Anywhere, and it's why our customers are so excited about this. But one other thing is when you look at work.com, that idea that we have to be ready to have a new way to work, that we have to be able to think about what is it going to be like to go back into the office. We're reopening our offices now in Tokyo, in Hong Kong, in South Korea, in New Zealand, in Australia, in Copenhagen. We're learning a lot. We're seeing this incredible new world of work. Not everyone is coming back to the office. And if somebody does get the virus and they get sick, well, we have to be able to do contact tracing. That's why, for example, we've actually deployed that technology in 35 states here in the US to help stop the spread. So providing manual contact tracing capability to these critical parts of our public infrastructure.
Yeah, Akiko, it's interesting to hear Benioff talk about how Salesforce has used its own innovation capabilities to really take on some of the challenges, the new territory that we're in, whether it's the work.com, which he just mentioned was 10% of their pipeline, or the Salesforce Anywhere product. You're really seeing an acceleration when it comes to some of these tech trends and I guess the future of work, if you will, and that it's going to be this digital environment. Some people might go to the office, some people might not, but basically live anywhere, work anywhere. Really interesting new world we're in.
Yeah, and it's certainly not going anywhere, especially given the concerns around the virus as well. Interesting conversation there. Thanks so much for that, Julia. And you can catch the full conversation with Mark Benioff on our website. It's at yahoofinance.com/presents. Well, just 90 minutes left to go in the trading day. We are seeing some steep losses across the board here. The Dow down about 2.5%, I should say. The S&P 500 down about 2%, and the Nasdaq down about 2% as well. Financials seeing the biggest losses today. The sector down about 4% on the back of the Fed capping dividend payments for banks and suspending share buybacks. We'll tell you what that means for the sector coming up on the other side of the break. Financials are seeing the steepest losses in the session today. That sector off more than 4% after the Fed suspended share buybacks and capped dividend payments for banks at current levels in the third quarter. The move came after the central bank's annual bank stress test, which showed that roughly a quarter of banks are likely to breach minimum capital ratios in the case of a double dip recession. Let's bring in Calvin Schnurr. He is the senior economist at Nareit. He's also a former economist at the Fed. Calvin, always good to talk to you. You know, there are some Fed governors that have suggested that banks shouldn't be paying out dividends at all at this point. But does this move that we saw yesterday go far enough in ensuring financial stability when you consider the uncertainty that's around the economic recovery right now and just the virus in general?
There's a lot of uncertainty, and that's exactly why the Fed did this move. This is really a precautionary move. It's a prudent move. What they're saying is the banks should retain any source of capital that they have in case the situation ends up a lot worse than expected. Now, the Fed ran three scenarios: a V, a U, and a W. Okay, we're familiar with the alphabet. What is this? A V means by the end of this year, economic activity is kind of back to where it had been. A U means it's a lot slower recovery, but by the end of this year, it's still not anywhere near back to where it had been. And a W would be a double dip recession. And what the Fed said is under all three of these scenarios, actually most banks would remain well capitalized. There are some banks that would come close to their required minimum capital, but they're not saying that they're really on the ropes. They're saying that they would be undercapitalized, not that they would be in risk of failing. So what specifically did they do? They said you're going to suspend all share buybacks. You can't buy back stock, which pays out money. You're going to limit dividend payments to what net income is. Now, net income is going to be really weak this year because they're provisioning against possible losses and so on. So you can see a lot of dividend cuts. But essentially, this means the bank's going to keep the money in-house. That's eventually going to be there for the shareholders. It's just saying, let's hold on to it and make sure we don't need it in the future.
Kelvin, you just highlighted the multiple scenarios we've been looking at in terms of the economic recovery. What do you think is the most likely? I mean, has the risk to the downside been elevated as a result of the flare-ups that we have been seeing in states in the South as well as the West over the last few weeks?
You know, as an economist, I've got to say this is really a public health question. There have been two main forces driving the economy and the markets lately. And one is, are we reopening? As you see reopening, consumer spending came back pretty strongly. We found it out in May. You're seeing increases in a lot of types of economic activity. But offsetting that is the risk of flare-ups, and we've seen that as well. And the fate in the future really depends on whether the current flare-ups can be brought under control so that we can reopen perhaps in a more measured rate than we had been. I think one thing that a lot of people are confusing is the thing we're either open or closed. You know, this is a dial. There's a long way between 0 and 10 or 11 if you're into that camp. We shouldn't go from 0 to 10 or 11. We should go from 0 to 3, then to 5, then to 7. And that way we might have a lot better chance at reopening without aggravating the spread that could endanger the whole scenario.
And Kelvin, I guess the question is, you know, what is this sort of stop and go scenario, this uncertainty around the virus? What does that do to consumer sentiment? We saw some good numbers today, consumer spending jumping about 8% in May, but that was after a historic low that we saw in April. When you look at how far we have come back from the low, what does that suggest on where the consumer mindset is right now?
Well, we actually also did see a reading on consumer sentiment, and it made a bit of a rebound as well, but it's still quite a bit below where it was before the crisis. And that makes sense because none of us has a really good measure of how this is going to play out. Ultimately, if we look a year or two from now, I think we're going to say, wow, that was a difficult, rocky time, but now we are back to a solid economy. The question is the path from here to there. So this morning's consumer spending numbers for May were good, up 8.1%. They retraced some of the decline. They still have some more to go to get back to where they had been, which is what you'd expect. You'd think that people are going to make the most essential purchases. We saw durable goods spending rise an awful lot. Auto sales rose when you could go back out on the lots. Those are sales people could do quickly. But other things are going to take a lot longer. The hotels, the restaurants and bars, those are going to take a lot longer. We're not going to get back to full speed right away.
And Kelvin, you know, looking through your notes, it sounds like you're pretty optimistic about the recovery? That, in other words, that this is going to stay on track? I mean, the question is how quickly things bounce back and how sustainable the levels we're seeing right now are. What's the biggest risk that you think could derail this?
Again, the biggest risk is the health risk, because if you look at the fundamentals, I think it's funny being described as optimistic, because I really don't have a great forecast. It's just I'm less pessimistic than the really pessimistic people. So relatively, it is optimistic. And why is that? Well, we still have higher incomes, higher household income, higher personal income than we did before this crisis hit. Now, personal income fell in May, but that was because the stimulus payments were mostly made in April. There were still some made in May, so stimulus payments fell. But one of the most important messages from this morning's consumer spending was also the personal income side. The wage and salary income rose by 2.75% in May. Now that's because people have come back onto the job. So you put together rising wage and salary income and the fact that the stimulus payments have lifted, we actually have more household income so far in this recession than we did prior to it. That means that there's a lot of spending power. There's a lot of potential spending power that's really waiting for the health scene to be clear.
Okay, Kelvin Schnurr, the senior economist at Nareit, thank you so much for joining us today.
Thanks for having me.
And we'll be right back. Economic data out this morning points to a big bounce back in consumer spending, up 8% in May after a historic low that we saw in April. The question is, how sustainable are some of these levels and the recovery that we've seen so far? Let's bring in Mark Zandi. He is the chief economist at Moody's Analytics. And Mark, I guess the broader question right now that we've been asking is, where are we in the recovery cycle right now?
Well, we're in recovery, early stages. The recession ended likely in May, so June would be the first recovery month. So we're moving forward. A lot of headwinds dead ahead, and a lot of things have to go the right way to avoid falling back into recession. But right now we're in recovery mode.
So much of the economic recovery, of course, contingent on how quickly the labor market bounces back. I've been looking at your report here where you recently revised your outlook on the employment front in part because of the uptick, for example, that you've seen in bankruptcy filings. We got the announcement from yesterday from Macy's, for example, saying they're going to be laying off a significant number of their employees. More of those reports likely to follow. When you look at those filings, what does that tell you about where the job losses are likely to accelerate and how far we are from realizing the totality of the economic damage?
Yeah, our forecast has not changed. It's been pretty stable since we caught up. Obviously, we're playing catch up through the month of March, but it's been fairly stable since April. And my sense is that we lost a little over 20 million jobs in March and April. We got a couple million back in May, and we'll probably recover half of the lost jobs, 10, 11 million by Labor Day. And I think that's where we're going to stay for a while until we're on the other side of the pandemic. I just don't see us getting a lot of those jobs back while there's social distancing going on, while there's the uncertainty around the virus itself, while those bankruptcies and failures you talked about are in full swing. So I think we kind of go sideways until the pandemic is over. And obviously that depends on a vaccine or a therapy that's widely distributed and adopted. And I don't know when that'll be, but it won't be until then that the economy really kicks into gear and we start getting all those jobs back.
So if we get half of those jobs back by Labor Day, I mean, what happens to the other half? Are those jobs permanently lost?
Some are. I do think we are going to see some fundamental shifts in some industries that are just gotten creamed here. The airlines, hotels, accommodation. I just don't see business travel coming back to where it was pre-COVID anytime in the foreseeable future. Retail, a lot of the brick and mortar retail jobs, they were evaporating slowly over time because of the online competition, but they're gone. They're not coming back. So those jobs, they're not coming back, and the folks that worked in those jobs are going to have to find other jobs. It's going to be a very painful adjustment. Hopefully, policymakers figure out ways to help those folks get the training and skills they need to move on to the next job.
When you think back to when the PPP was first, when the loans first started going out, there were a lot of small businesses who said, look, we can't rehire within a 2.5-month window. Obviously, that timeline has shifted now. How much of that is now sort of prolonged the downturn that we're seeing in the labor market? I mean, if these businesses have a longer window, are you seeing they're likely not to hire until the end of the year or rehire until the end of the year?
Well, I think the way I would frame the impact of the Paycheck Protection Program (PPP) on the labor market is that the benefit of the plan is probably peak. We're probably past the peak. That the small businesses that took advantage of the program early on and have rehired and have kept people on payroll, they in some cases, are not going to have the sales they need to maintain those payrolls and will start laying off. But because of the changes to the program more recently, we'll see some businesses start availing themselves of that, going forward. So you have these countervailing forces. But on net, I think it all plays out to the PPP's benefit to the labor market in terms of jobs, unemployment, the broader economy is probably the peak of the benefit is probably behind us at this point.
And while we're looking at strictly at jobs right now, I mean, there's so many other factors that go into somebody's ability to return to work. There's still question marks around how schools are going to be conducted, depending on the county, the state. How many of them are actually going to be returning? And parents have been very vocal about the challenges of having to conduct these remote classes while also working from home. What have you been hearing about that element or that part of the picture and how that's likely to affect somebody's ability to return to work and be productive in the way they would have been pre-pandemic?
Well, I think there's just complete confusion. I don't think there's any plan at this point. I think people are just kind of waiting and watching, seeing how the virus plays out this summer and making it as we get closer to the school year, then make some kind of decision as to, should schools open? And if they don't open, how will they conduct themselves? What will we do? And it's not only K through 12, obviously universities and higher education have the same kind of questions and issues. So I think there's just going to be a lot of question marks until we kind of get up to August and September, and then see where we stand with the virus and how we think things are going. But you make a great point. That's another reason to suspect that the economy isn't going to get all those jobs back. The economy is just not going to get back to pre-COVID levels until we're on the other side of this pandemic. It's just hard to imagine that that's going to happen. And this is one other reason why. The social distancing, the uncertainty, it's just, I think, going to be very difficult for people to really fully engage until there's a vaccine or a therapy that we feel comfortable with.
Yeah, still a lot of uncertainty ahead. Mark Zandi, always appreciate talking to you. Thanks so much for taking the time. Moody's Analytics Chief Economist.
Thank you.
Well, CEOs of major U.S. airlines are meeting with Vice President Mike Pence to discuss COVID-19 measures, including mandatory temperature checks for passengers. Emily McCormick has been tracking the latest developments on that front. And Emily, we've now heard from American Airlines coming out saying they want to resume full flights, a full schedule coming up in July. United saying they're going to be adding additional flights now to China. But there's still a lot of questions about whether passengers are going to feel comfortable about flying without the proper measures in place.
Absolutely, Hiko. And that is definitely going to be one of the big topics of discussion. So we do have multiple media reports saying that a meeting between Vice President Mike Pence and the CEOs of major airlines, including American, Delta, Southwest, United, and JetBlue, took place today starting at 2 p.m. Eastern. No headlines coming out of that just yet, but the topics were reportedly set to include discussions over passenger contact tracing, impacts of COVID-19 on travel demand, and those potential extensions of European Union restrictions on U.S. travelers. Now, one of the things airlines have been pushing for recently is for the Trump administration to mandate temperature checks for passengers in order to help reassure those flying that flying would actually be a safe measure for them to actually take. It would also deter those who are under the weather from traveling, and something that could potentially help bolster demand for these airlines, especially as we've seen their capacity just get obliterated in recent months. Now, to your point on American, we did get an update from the company today saying that it would be booking flights to capacity starting July 1st. That's next week, meaning that those middle seats will also now be available for purchase. It did say that it will let customers know when more flights are open and will let them change to those free of charge. And then starting Tuesday, the company is also going to be asking customers to certify that they have been free of COVID-19 symptoms for at least the past 14 days. Now, we do see shares of that company as well as United each off more than 7%. So the airline stocks are taking a hit today. Akiko?
Yeah, we have seen steep declines on those airline stocks over the last several days. Thanks so much for that, Emily. We're off for another break, but coming up, we're going to be talking about what's developing in Texas yet again. Hospitalization rates there from the coronavirus up for a 14th straight day, and that has prompted Governor Abbott to roll back some of the reopening plans. We'll speak to one business owner about what that means for his restaurants coming up. Stocks hitting session lows with just over an hour left to go in the trading day. We are seeing the Dow now off 746 points. Part of the concern in the market, of course, the number of coronavirus cases continuing to tick up in a number of states. Texas, certainly one of the new epicenters that have emerged. We have seen hospitalization rates there up for a 14th straight day. That has prompted the governor there now to roll back some of the reopening plans, including reducing capacity for restaurants from 75 to 50%. Let's bring in Tony Montero. He's the CEO of High Hospitality. His restaurant group operates multiple restaurants in Dallas, Austin, as well as Houston. Tony, it's good to talk to you today. Give me a sense of what it is your restaurants are having to deal with right now, given what we heard from the governor today.
Yeah, I mean, thanks, number one, for having me on. And it's day by day. Every day, as some days it's really hour by hour, things are changing. We were fortunate because we never went to the 75% capacity. We always stayed at that 50% capacity. And one thing with the 6-foot distancing, it makes it really hard to get to 75% anyways, because you only have so much room in your dining room. Because that's 50% of your indoor dining, so you can have some outdoor patio seating that is not included in that total. So we've never exceeded that 50%, so it didn't really affect us at all. It affected many other businesses, and it also changes your strategy, because we were going to put up plexiglass between our booths because you could start doing booth to booths back to back, even if there wasn't 6 feet. So we'll still put the plexiglass in, but at this point we've chosen, obviously, we're not going to seat those. And we're going to continue on with kind of the status quo that we're doing right now, which is under 50% capacity, as well as our curbside and our patio business.
We've heard from so many restaurant owners, not just in Texas, but places like Florida as well, the challenges of enforcing mask wearing when it's not mandated statewide. Can you speak to the experiences at your restaurants? Have you seen most of those who've been coming in wearing masks, or have you had to kind of deal with some customers who have said that, I'm just not going to do it, and that being a big concern for your employees, I imagine?
Yeah, we actually put in the mask, quote unquote, mandate in our restaurants well before the mayor asked for it, before the governor kind of hinted towards it. So we've done it since the day we reopened. We actually started it, implemented about halfway through the to-go process, where we put our staff members in mask, and then we would go out to the cars and only go to the opposite side of where the driver was, unless they had a mask on, all those pieces to kind of already enforce that. There are definitely, we won't let a guest in without a mask, and we've been doing that since we reopened. There are some guests that don't understand and, absolutely get upset. A manager will go then and talk to them, and that's just going to be our policy. It's for the health and safety of all our guests and our staff. And, it's tough. I can tell you, it made it easier in Houston, Dallas, and Austin in the last week when all the mayors there mandated masks. So then it just made it easier for the staff to just say, it's mandated. It's not even our rule anymore. It's mandated.
Tony, how big of a hit have you taken over the last few months, and how are these new measures likely to add to that?
Yeah, when we closed down on March 17th, we had one restaurant that had already done to go, so it was a little bit easier pivot. But even at that, you dropped sales by 60-70%. We had our high-end sushi Japanese restaurants that had never really done to-go business before, that in a 3-day period, we were looking prior to that on with a team, like, in case this happened, let's look on a to-go menu. So we put together a to-go menu, pivoted to go. And for that 2-month period before restaurants were open, the team did an amazing job, because we went from full service fine dining restaurant to go from that Tuesday to that Friday night. We started to go that Friday night in our Uchi locations, and the first couple nights were very hairy. We were all trying to figure it out, and then we figured it out and made a really great guest experience. It's tough. I mean, even when we were at the 50% level, you're down anywhere from 50 to 30% each week. And as the margins in restaurants, as everybody knows, you're not making any money. You're just, what we're doing is protecting the brand, protecting the company, and, giving some of our staff some opportunity to work.
Tony, wishing you the best of luck as you have to deal with this outbreak now. Tony Montero, the CEO of High Hospitality, joining us there. Coming up, we're going to be talking about the big lift Kanye is giving stocks or shares of Gap. Sibyl Marcellus will explain after the break. Shares of Gap popping in the session after Kanye West announced he's collaborating with the clothing company to develop a new line. Sibyl Marcellus is here with the details on that front. And I guess, Sibyl, the question is, can Kanye be the magic to turning Gap around?
That's definitely what Gap is hoping for. The stock was hot this morning once the news became known to investors. It was up about 30%. Right now, it's up about 17%. It added more than 1.4 billion to Gap's market cap. And this is a really big deal because Gap's sales plunged 50% in the first quarter. So they really need this. And as a part of this partnership, we're going to have Kanye developing a clothing line for Gap for men, women, and children that will be sold in physical stores and online. And the Yeezy Gap line will debut sometime next year in 2021. Gap did not disclose the exact terms of the deal, but we do know that Yeezy will get royalties and may get equity depending on how sales go. Now, it's interesting to note that Gap is hoping this works as well as Kanye's partnership with Adidas for Yeezy sneakers. That sneaker line has become a billion-dollar business for Adidas. It launched in 2015, and Adidas's sneaker section is worth more than $3 billion. At least that was the case last year. We'll see how the coronavirus pandemic impact that, but that is the case. So Gap definitely hoping that they'll be able to get some of the success Kanye had with Adidas.
Yeah, certainly looks like investors are liking it, at least on the day of the announcement. We'll stay tuned for the clothing line. Thanks for that, Sibyl. That does it for the ticker. The final round is coming up next.
All right, good afternoon, everybody. Welcome to the final round here on Yahoo Finance. Miles Udland with you in New York. Let's take a look at this market. We've got a sell-off on our hands here on a Friday afternoon. All three majors down more than 2 percentage points right now. The Russell 2000 also off more than 2.5%. Of course, news on the virus we'll get to in just a second, but also news last night from the Federal Reserve and the banking sector. We'll talk to Brian Chung about that in about 5 or 10 minutes. But taking a quick look at financials, KBW Bank Index off some 6% today. When you look at the Dow, the biggest losers, JP Morgan, that stock off 5.5%. Shares of Goldman Sachs, they're down more than 8% in afternoon trade here. So financials really dragging the market lower. And then all of that, of course, combined with the discouraging news that we continue to get out of Texas, Arizona, Florida, among other states, California. Of course, let's go right to Anjali Khemlani for the latest on Anjali, what we've learned. And I think that perhaps the biggest sentiment check today is we see the coronavirus task force holding a press conference for the first time in a couple of months. Shades of March, it feels like in today's news flow.
That's right, Miles. We did hear from them today, and it was definitely a mix of really pumping up positive emotion about the recovery in, some of the states that have, in fact, done a better job of flattening the curve, like New York, New Jersey, and the Northeast, but kind of shining a light on exactly what we've been talking about, which is the concern coming out of these southern states. And while there were sort of minor differences that were highlighted on why the cases in the South were not as concerning. Number one being that a lot of younger people are getting tested and testing positive. And what does that mean? And a lot of younger people are also being hospitalized. And what does that mean in terms of the recovery rate versus a death rate? Now, we still don't know what that death rate is going to be as a result. Of course, the younger population is a factor, as well as the fact that we won't know what those deaths are what that death rate is going to look like until 2 weeks at the very least have passed, as we know from the experience in the Northeast. And so that's definitely, what we're seeing. We also know that in Texas and in Florida, the two really major hotspots right now, it's surging cases, hospitals really in trouble right now. Yesterday, with the halting of elective surgery, and now in Texas, looking at closing down of bars as a result, with the governor sort of citing that as a reason why the state is seeing surging cases. But meanwhile, going back to the coronavirus briefing, that was definitely the first time that we've heard from everyone in a while. And it was Dr. Fauci, Dr. Birx, and Secretary Azar, along with Vice President Pence. And most of the messaging was just about what is happening and what the treatments are. That was something that Secretary Azar touched on. But something that came out of Dr. Fauci's portion of it was just, cautioning that everyone has a role to play. And I think that was one of the biggest takeaways of what he was trying to say was everyone has a role to play in how this goes forward, because even in the states that are doing well right now, with the virus circulating as much as it is, and with the surges anticipated in other parts of the state of the country too, if it increases overall at an accelerated rate, it could be dangerous for the areas that have already recovered, including New York, New Jersey. So while we're already waiting for a second wave in the fall, we might see yet another bout of it before then if things continue on this track, was that warning. Miles?
And then Anjali, just on testing, there were reports that earlier this week, Florida would the government would end its support of federal aid for testing in Florida. Texas announcing today that they're going to extend their federal testing program by a couple of weeks. Fauci making mention of maybe a new testing strategy is needed. It seems that, everyone was content in the spring to say, New York and New Jersey, you guys figure it out. And to some extent, these states did. But it does feel certainly like a national strategy may be in the offing in the months ahead.
Right. And that's something that the health experts had been calling for, because a lot are saying that if we had a better clue about where the hotspots were rising before now, we could have done a better job. We, the collective, we, the U.S., could have done a better job of, tamping down these surges. And one of the things, too, you mentioned Fauci's comments on pool testing and what that means, which is really targeting that asymptomatic population that isn't prioritized in testing right now. And so looking forward, if they are, in fact, included included in the testing that will help, as well as more of what they're calling a surveillance strategy, which is just finding these hotspots versus just waiting for people to get sick and then dealing with it at hand. So that is definitely something that the task force is looking at. And then to reiterate, it's not to find the individual cases, but just to see where there might be a prevalence of cases that are being missed right now.
All right, Amjad Kemlani with the latest on the coronavirus outbreak. We'll talk to you at the top of the next hour. Again, market sell-off today on this Friday afternoon. Let's go right to Jared Blickery for a bit more. Jared, on what stands out to you in today's action.
Yeah, getting kind of ugly on a Friday afternoon. Financials leading the way down after those stress test results that we got after the bell yesterday. Also, communication services taking a huge hit. Facebook in the limelight for reasons we're going to talk about. Lots of sponsors pulling their ads. But let's take a look at the charts here. Here's the Dow off 700, NASDAQ down a little bit less, about 2.2%, and the S&P 500 down similarly. Here's the day's price action, and you can see after the big drop this morning, we kind of consolidated, and then we just started taking another leg down about 130. How low can we go? Let's go out to a longer time frame chart. We are now below the 200-day moving average, which is right about at 3,020. Not the biggest drop or break, not the biggest break of it. If we close above, that would be a positive sign, but 3,000 is a target. And then if we break that, we could go all the way down to about 2920, and that would be around this breakout area here. Of course, we can always go lower, but those are the most immediate support lines that we're watching. And then we got to take a look at the VIX. That is climbing as we see risk increasing. And one of the comments that we've been making over the last couple of weeks is that even when equities were rising, the VIX really was elevated. That's also evident in the VIX of the VIX, although that is dropping right now. And then the 10-year T-note yield. So we are looking at 65 basis points, as a support area. And that is now broken to the downside, 64 basis points. If we head lower, yield curve probably contracts, and that's concurrent with another drop in equities. And now let's check out our heat map. The big FANG stocks under a lot of pressure. Facebook having its worst day since just before the market bottomed, March 16th, and that's when it dropped about 14%, so double that, but taking direct hits to its revenue. Alphabet off 4% as well. And then looking at the travel names, those have been a sore spot as of late. We have cruise lines down about 4 or 5%. United is down 7%. So travel names getting hit as well, Miles.
All right, Jared Blickery with the latest on where things stand in this market right now. And Jared mentioned the financial names and certainly some news there, conflicting news yesterday. We saw stocks rise on news that the Volcker rules would be rolled back a little bit, but then last night after the close, those stress tests really putting financials under pressure today. Brian Chung joins us now and for the hour. But Brian, let's start with what we heard from the Fed last night and specifically what's putting Goldman Sachs and Wells Fargo under pressure here when you look at financial stocks in today's trading.
Yeah, Miles, well, it seems like right now everyone could use a stress test, but specifically the banking industry needs it, especially in light of the COVID-19 crisis. Now, keep in mind, stress tests are part of the Federal Reserve supervisory framework that they've had since the crisis. This is not something that they added specifically for the COVID-19 purposes. And the stress tests incorporate what they call a severely adverse scenario. It tries to model an economic downturn to see if bank balance sheets can handle it. Now, the problem is that the severely adverse scenario is not as bad as the real life situation that we find ourselves in. So the Federal Reserve, in addition to the regular stress test, added what they call a sensitivity analysis, where they modeled out a V, a U, and a W-shaped recovery to see how the banking industry at large would do. Even though the regular stress tests break out those results individually by bank, this supervisory sensitivity analysis just aggregated the whole industry. The Fed didn't want to single out single banks for the purposes of this exercise. And what they found was that all the banks would do relatively okay. They said the capital would be all right, but a number of banks would reach pretty close to the regulatory minimums that they face from the Federal Reserve. For that reason, the Federal Reserve said they would A, require the banks to extend their current suspension of share buybacks, and then B, also cap their dividend payments. They can still pay a dividend, but it can't be larger than what they paid in a previous quarter, or it can't be the more of the average of the last 4 quarters of income. So the Federal Reserve pretty clearly saying we do think that the banks are in a good position, but we don't want to allow banks to too richly pay out to their shareholders. Now, it wasn't a unanimous decision. You had Lael Brainerd from the Federal Reserve Board dissenting against that decision, asking the question, why are we allowing banks to pay dividends in the first place? Why not we just eliminate the whole thing if we're also going to ask them to suspend share buybacks? Keep in mind the Federal Reserve vote ultimately overpowered her. It was a 4-1 vote, so they did go through with that motion. But you can see bank stocks still taking this pretty poorly. You have State Street down almost 6%. Goldman Sachs taking a real big hit right here, 8.8%, and JP Morgan Chase almost down 6%.
Well, and Brian, I wanted to ask a bit about the dissent that we heard from Brainerd. And I guess also it kind of leads to, as you mentioned, the most adverse scenario within the stress test is not as bad as what we're seeing now. And yet, I think that the financial sector has actually come through this quite well. I think in many ways, the way we've seen the financial sector behave during this crisis affirms the pose that regulators took. And I'm surprised that there seems to be maybe some disagreement about what the future of regulation ought to look like, considering, again, I think it kind of works.
Well, one thing that Brainerd would probably agree to is that broadly capital levels among the banking industry, at least here in the United States, are much higher than they were before the 2008 and 2009 crisis, which you could argue was a reason why that crisis was as deep as it was because the banks were so poorly capitalized for the situation that it found itself in then. Now, the banks have appeared to stand up pretty okay through this crisis so far. We don't know what's going to happen down the line, and the Federal Reserve stress tests appear to corroborate that. But I think Brainerd's dissent is rooted in the idea of the uncertainty over the future, that you did have some banks that were reaching pretty close to those regulatory minimums in some of the sensitivity analyses that we saw last night. Now, the Federal Reserve did not disclose which banks they were, but if you look at, for example, what the scenario would be under a W-shaped recovery, it could be an upwards of the bottom percentile, the bottom quintile rather, of banks that were stress tested. 33 of the largest banks might not have met their regulatory minimums. So that's something that could be of concern. Now, something important to delineate is that meeting your regulatory minimum does not mean you're in risk of default, does not mean that you're at risk of a bank run. It just means you didn't meet whatever arbitrary line the Federal Reserve set. But I think there is some disagreement within the board. Other Fed presidents have said it so well over whether or not you do want to suspend dividends, as, by the way, is the case in the European Union, for example. A number of regulators there have told the banks not to pay out dividends.
Yeah, and I think all of this kind of leads to this conversation that comes up from time to time, which is that everyone looked at 08, and I think it happened during this crisis in March. They said, we will not have a solvency issue in the financial sector ever again, so long as all of us regulators remember what happened in 08. Now, obviously, there's other problems to deal with right now, but it does seem on capital requirements, things have been all right. All right, Brian, hard pivot, man. We're going to go from your area of expertise, the Fed and the banking world, to the world of fashion that I know you care deeply about. You like to keep some Easter eggs there on your set. I know you're going for the ones right there, but let's not talk Nike. Let's talk Adidas, Yeezy, and the Gap. That stock is up 18% today on news that Kanye West's Yeezy brand will collaborate with the Gap. They mentioned, Brian, in the press release, Ye used to work at the Gap back in Chicago. So only natural, I suppose, that the Gap now moving upscale with the Yeezy brand.
Well, you could argue that Kanye willed it into being because in 2004, on one of his songs on what I think is arguably one of his best albums, College Dropout, he mentioned, "I'm the Gap like Banana Republic and Old Navy," literally spelling out every of the large brands under that stock GPS. But I think that what's important here to remember is that this is not going to threaten the shoe deal that Kanye has with Adidas. This is just for clothing. But I got to say his success with the clothing brand has been quite mixed. He's had a number of Yeezy seasons that have not been too commercially uptaken. You could argue because it was also a luxury brand. They didn't make a lot of it. But in my opinion, it just kind of looked like trash. It was a lot of kind of earthly tone, random, kind of plain old T-shirts and ripped up things that I could probably get myself at Uniqlo. But I think regardless, Ye's power, which you can see through his Yeezy brand, is something that maybe he can bring over to Gap, hopefully. But I just got to say, for the record, I'm more of a classic guy. I like the old classic styles as opposed to those Yeezy 350s, which I honestly think have been adopted too much by high schoolers. But.
And Brian, of course, if that manifestation is a trend, then you should probably partner with Hollister, right? Because you worked in retail.
Okay, that's uncalled for. That's uncalled for.
If we're talking about tie-ins here, but I think the bigger point is that this won't change Gap's trajectory. To be honest, I think sales at Gap's namesake brand, they were down about 50% in the first quarter alone. The company has actually skipped rent payments during this period of time. I know they're not alone, and they're being sued by various mall owners across the board. So just thinking about the kind of structural problems within Gap's empire for quite some time. We know they had scrapped that deal for Old Navy to spin off into its own entity. I don't think just some interesting, cool Yeezy branding will necessarily solve all of their legacy issues. But I do have to say one kind of silver lining here is it shows that some of these brand names and perhaps mass market brands, it shows that there's still some appeal, right? That there is still this wide net, that they can access a large audience. We know a couple months actually announced Gap Teen to try to get that up and coming customer, to get them while they're young and to actually be able to pursue their purchasing power. So I do feel like there is a potential market. I just don't think it's a game changer.
What a week for Gap. I had thrown Gap to the sidelines. I thought that they were down for the count. And we got a double upgrade from Wells Fargo this week. First of all, talking about Athleta. We always talk about Lulu, but they think there's huge value in Athleta. They had a really big day to start off the week. And then here they are ending the week with this deal. I did not, even with, I mean, Brian, quoting the lyrics there, and I read that, Kanye had worked at the Gap. I didn't see this coming. I did not see this coming. And it'd be hard to script something better than this week that we've seen for Gap. I mean, I know that they're still down a lot, but I think it shows that they're trying some things that are outside the box, and there's life in this brand. And also you got to pay attention to Athleta, which is what Wells was talking about earlier this week.
Yes, what a week it is for the Gap. And I think it now brings up the question. We talked about it with the Cody deal a couple of weeks ago, their tie-in with the Kardashian family. Who will be a CEO of a publicly traded company first, Kanye West or Kris Jenner? I think it's an open question. And I think there's now a path for both of them at this point.
Gosh, I guess I'm going to go with Kanye. You think?
Well, I mean, I came up with the Kris Jenner idea when the Cody deal came through like 3 weeks ago. But I mean, I don't know if it's why not both for sure. I'm just saying first, who gets there first? I think it's something that's in the future of the family, of the conglomerate, I guess you could say. But certainly interesting times. And all that. All right, coming up on the other side of this break, we're going to talk about our call of the day. Today, we're talking about SunTrust's latest on shares of Amazon, putting a $3,400 price target on the stock. We'll discuss that call coming up here in just 2 minutes. All right, welcome back to the final round here on Yahoo Finance. Miles Udland with you in New York. Let's take a check of the market here with about 40 minutes to go in today's trading session. Losing some ground here. The Dow now off some 720 points or 2.8%, right near lows of the day. We'll see if we do indeed roll over as we head towards the closing bell again on this volatile Friday afternoon. But let's turn now to our call of the day. And today we're talking about SunTrust's latest on shares of Amazon, putting a $3,400 price target on the stock. That's up from $2,700 per share. They're reiterating their buy rating on the stock. And Jen Rogers, SunTrust saying in many ways what we all know about this time where e-commerce trends are accelerating. But it is interesting to see, I think SunTrust noting that Amazon does have serious competition when it comes to online commerce, saying that their net promoter score, a term from another era, is a positive here for Amazon as people look at things like Walmart.com and Target as real options instead of Amazon in this time.
There's definitely competition, but what this note drove home for me is that I think sometimes we who live in New York City and order from Amazon all the time, yes, I'm talking about myself, miss parts of the Amazon story in that not everybody has been on Amazon. And they drive that home in this note, saying that 10% of people said they purchased from Amazon for the first time since during the COVID-19 shutdown. An additional 8% said they had purchased from Amazon for the first time in over a year. So they reactivated. So the idea that there's still some growth left here, right? We were looking for growth in other areas. We were looking at AWS and what are they going to be doing with Twitch and video games? Well, actually, there's growth in the retail part and that getting those stickiness and those people in. And I just, it just surprises me that there are that many people out there. And in fact, there's still room to grow in retail.
And I think another interesting part of this note, Melody, is SunTrust pointing out that Amazon, even though it seems like you can get something shipped to you in 2 days from any retailer, Amazon does have an advantage when it comes to their logistics network. And they note specifically how, and we all remember this, shipping times were a week back in April, and now it's back to next day. Pretty much everything on Prime is next day or 1 day. And that 2-day free shipping, which became the table stakes, Mark Lowry famously said 5 years ago, that's now kind of out the window.
Yeah, and it's so interesting. We were just talking during the break about TikTok, and actually Walmart is one of the biggest advertisers on TikTok right now, specifically to compete with this quick, rapid delivery service. There's actually a hashtag that's trending specifically about getting it within 2 hours. And we know that that was another area that Amazon was trying to offer that premium service to be able to get a smaller window even sooner than day. I do feel like the fulfillment centers obviously gives it a leg up, but I want to pivot a little bit and talk even about the advertising business. We know that was one of the growing sectors of the Amazonian empire, and we'll talk about Facebook, of course, later, but just thinking about the way that companies are shuffling their ad dollars right now, I imagine that Amazon will be the biggest benefactor, right? It's not necessarily going to more interesting startups or taking a daring bet here or there. People know that it's Facebook, Google, and then Amazon is following closely behind. So I know it's not explicitly stated in the note, but I do feel like that's an area that some analysts are actually saying could potentially surpass AWS over the next decade.
Well, it's no secret that Amazon's been on a tear. And when you look at year to date, which obviously doesn't mean that much in the context of what we're seeing, but the stock is up 47% compared to the Dow Jones, which is down 12% for the year. But I actually want to take the other side of Melody's argument here, which is the Facebook argument. When you look at what's going on with their advertising, which we'll discuss later on in the show, part of me does wonder if that's actually a downside risk for this Amazon stock as well. And then obviously Amazon's business model is different than Facebook's, especially when it comes to advertising. But when you look at the idea of these being two large companies that have gotten pulled into a lot of these social debates here when it comes to things like false news or things like political speech or hate speech on their platforms, Amazon, not necessarily on the speech side of things, but on the treatment side of things with the way they've been handling their workers, the way they've been handling their fulfillment centers through this crisis, for example, you do wonder if there is that social risk that companies might want to tie up with them in a business contract as well. So I think that's something that analysts might be expected to zone in on, especially in the medium term for this company.
And it's interesting, Brian, just because if you go back in time, Amazon, Washington Post, Jeff Bezos, that whole thing, I mean, that's still part of the conversation, but certainly these social networks are at a different point in their life phase with respect to their political problems and how that's impacting their business. And Amazon, at least on that count, very much not going to be dealing with that, it appears, over the next couple of years or so. All right, coming up on the other side of this break, we're going to talk about retirement and why 2020 may be the most dynamic year in history for your retirement plan. We're back with that conversation in just 2 minutes. All right, welcome back to the final round here on Yahoo Finance. Miles Othen with you on this Friday afternoon. It's time now for Retirement Ready, brought to you by Fidelity Investments. And today we're joined by Dan Griffith. He is a Senior Vice President and Director of Wealth Strategy over at the Huntington Private Bank. And Dan, you write that 2020 may be the most dynamic year for retirement plans, but this isn't just about what's happened in the market. This is technical changes to the way people can and can't save for retirement. Can you kind of outline that thesis for us and what people need to know about what may have changed with their plans this year?
Absolutely, Miles, and thank you for having me. I think one of the things that we've forgotten with all the market volatility is the volatility that's existed in the regulatory and legal environment when it comes to retirement plans. We've seen some changes when it comes to IRA rules and 401k rules and other qualified plan rules that have been unprecedented over the last 7 months. It's been really interesting and remarkable. And I think we're in for a little bit more transition, frankly, as we go through the rest of the year.
And so as you see it, Dan, what are some of the biggest things that people need to be aware of? Let's say you're not retirement age, but you are planning for retirement. Are there things that have changed that people need to be paying closer attention to, perhaps?
Absolutely, yes. We know that the Secure Act, which a lot of us have heard about, passed very late in 2019, and it affects every single person who's out there planning for retirement. It allows people who are closer to retirement to do some additional savings, which is helpful. But it really also allows each of us to kind of look at what the numbers look like from a retirement standpoint a little bit differently. For example, because of the Secure Act changing and because of the rules that followed with the CARES Act, a lot of our clients, Miles, are looking at whether or not a Roth conversion makes a lot of sense right now. And so the numbers, as you begin to run them today, are different than they were even back in February, which is a very, very dynamic thing to consider at this point.
And so let's maybe then turn to how this environment has changed things for some of your clients and how you're thinking about things. What have those conversations been like? And maybe we could break it down by folks closest to retirement, kind of folks in the middle, and those just starting out saving.
Well, I think a lot of it, everybody wants to review retirement in a very different way. And I think if we look at it, I have a sister who's beginning her professional career, and we sat down the other day to talk about her retirement. And it's funny to think that as she is in her early 20s, that really her retirement is going to look very different than even mine in my early 40s is going to look like. She may be in a position where, very different than our grandparents who worked at a mill, finished, and at 60 years old retired with a pension. She may be in a position where throughout her career, as is true for many millennials, they may say, I want to work for a while, I want to take a couple of years off. Maybe I want to have 2 or 3 different jobs at the same time. And maybe in those cases, they might not offer the same kind of traditional plans that other people will. So emotional drivers are different. I think time horizons are very different. A lot of people really enjoy the work that they do. And so retirement is something that they consider in a very different way because work is not so onerous. If you really like what you do, retirement isn't the kind of driver that it might be otherwise. So time horizons, and as we've seen, I think one of the biggest legacies from the COVID experience, our priorities when it comes to family connections or connections to our communities may be a little bit differently too. If you've lived far away from your family in this experience, I think a lot of people are considering whether or not it's going to be easy to jump on an airplane and be close to those that you love. So everybody's talking about that in a little different way.
Dan, I guess the answer to this might vary depending on who you're asking in terms of that retirement timeline, young workers or people just about to enter retirement. But when you look at the last 3 months, the financial markets, different asset classes have just shifted so dramatically, which might have brought up the idea, should I rebalance or change my retirement investment strategy here? What have you been telling people? What have you been observing in terms of how people have been weighing equities or high risk equities specifically in their retirement investments?
Yeah, John Augustine, our chief investment officer, has done a lot of work to make sure that we've been doing thoughtful rebalancing, and that's been very effective. But I think what's interesting when you talk about rebalancing to a client, it's something we always need to consider. But we've been stepping folks back one more position to say, let's reevaluate what your goals even are. I talked to a business owner the other day who said, I'm sure that I can make it through this difficult time in my business, but I don't want to. I don't have the energy, and I'm not sure I want to do it. His wife happened to be somebody who was a nurse who'd had a great career in a hospital, and she was intending initially to work about another year or two. And she said, I also don't have the energy and time. I want to make sure that my position is open for somebody who's able to come in with new energy and kind of fulfill that role. And so before we even talked to them about what the logistics of their portfolio looked like, we had to go back and reevaluate what their goals were. And I think in a lot of cases, people don't appreciate that their feelings may have changed in that respect. It's something that's very different as a consequence of this crisis.
All right, Dan Griffith with the Huntington Group. Always great to get your thoughts. Thanks so much for joining us. Have a great weekend.
Thank you. You too.
All right, coming up on the other side of this, Facebook shares having their worst day since mid-March. A number of advertisers pulling spending on the platform. We have all the details coming up here in just 2 minutes. All right, welcome back to the final round here on Yahoo Finance. Miles Southern with you on a Friday afternoon. Let's check quickly on the markets here. Again, losing some steam. The Dow now off nearly 3%. The S&P right near lows of the session, off about 2.5%, trading just above 3,000. So really back where we were at the close last Thursday. You'll remember 2 Thursdays ago, Thursday the 11th, we had that 6% sell-off. Really haven't gone anywhere since then. Obviously, the virus situation, not good in a couple of words. So we will be discussing all that coming up as we head toward the closing bell. But let's turn now to, I think, really the story of the day, and that is what's happening over at Facebook. Melody Hahn, those shares are down some 7%. And it seems even during today, momentum growing among major advertisers to pull a lot of their spending from the platform, some through the end of this year at least.
Yeah, exactly. Some, including Unilever, which is the 33rd biggest advertiser on Facebook, at least for the month of June. The company spent about $2 million in June. And it's worth noting, Miles, that a lot of these conglomerates, even the small businesses who have decided to pull ads, they're not removing ads from non-US sites. So this is very much a domestic issue. Their rationale that a lot of these kind of hateful commentary, a lot of these racial discussions that are often explicitly racist on the platform that tend to do particularly well, those conversations are happening in the US. We can have a separate debate about that because we know that these sorts of conversations are happening globally right now. But we've talked about this story all week, right? Thinking about the Eddie Bauers of the world, the Patagonias, North Faces, and Ben & Jerry's, which is the first subsidiary to kind of take this stand. And it just shows how rapidly moving this situation is right now. I think one of the glaring questions that we've discussed on this show too is, what does this mean for Facebook's advertising revenue at large? Of course, ads make up 98% of Facebook's entire portfolio of revenue. Originally, they were banking on Libra to bring in more VR and AR, of course, which has been a sputtering project. So advertising is basically its bread and butter, and they were hoping that it would be unlimited upside, but that may turn out to be soon a fallacy, perhaps, that there could be a ceiling to how much consumers in particular are willing to put up with. And we've talked so often about individual campaigns and petitions that have performed relatively well from the social media buzz side of things. But if you think about it from the advertising side, a lot of the scrutiny has come when a lot of the parent companies reshuffle the dollars and say, hey, we'll put it on a different program, or hey, we'll pull it off for a month and then we'll restart it when no one is paying attention. I do feel like the momentum and the heat are very real right now. And I anticipate that this will be a continued discussion at least until 2021, right? And originally, we were talking till July, maybe through the summer, but I think Unilever kind of coming out and taking a stand saying at least through all of 2020, that's a pretty big deal. And one other note, of course, Procter & Gamble has been under scrutiny as well, saying, hey, why are they not pulling their ads? They are, of course, up there with Unilever when it comes to advertising dollars. However, we are hearing some news that they did have a town hall a couple days ago, and they are, quote unquote, reviewing all of their options and not just social media when it comes to the kinds of platforms that they're choosing to advertise on.
Well, and Melody, think about the Facebook viewpoint. You mentioned that unlimited upside. They think they're running an advertising and news and content platform, but I think what brands are telling them is they run a political platform first. And I think also related to that is what's happening over at Twitter. It's a political platform first, and for most consumers, that experience is negative. So let's turn the conversation now to Twitter, and we'll talk to one group that is trying to maybe turn that conversation from a strict negative to build some positive momentum behind what's happening over on Twitter. We're joined now by Xander Schultz. He's the founder of the new super PAC Defeat by Tweet. So Xander, I guess kind of start with explaining what your goal is here, and then maybe we can get into just what opportunity you saw on Twitter, because as I outlined, I don't think any of us think it's controversial that Twitter mostly sucks, but maybe there's a way to turn that around.
Yeah, I think we're definitely capturing some of that energy that you're speaking of, which is, these platforms are kind of in a bind. Like, they're housing this like hate speech, and people who are pushing, racism and bigotry are being rewarded with following, or at least attention, right? Like, I think Trump seems kind of agnostic whether it's good or bad attention, but he wants attention. And so these guys are doing this basically without consequence. And so we wanted to flip that on his head and say, collectively, we can add consequences here. We can be the equivalent of like the soda tax as a group and say like, look, now every time you open your digital mouth, not real mouth, digital mouth, you're going to know that you're going to be funding Black community organizers in all the swing states that are turning out their communities to vote down ballot to get the DAs, the sheriffs, the judges, the local officials they deserve. But all of that energy also translates up ballot and usually doesn't translate into a Trump vote. And so I think we're trying to kind of capture two energies. One, we're all sick of this guy and we want to do something, anything, to give him some consequences. The guy's lived without consequences his entire life. This privileged guy has just gone around and hurt people. And then secondly, we're having a very mature conversation about what is our moral obligation to Black Americans and how do we lean into this? And, I work for a family office over here that moves millions of dollars into criminal justice reform. We believe, one of the best ways we can do that is help Black communities build the political power they deserve and help them get the officials they deserve, the local officials they deserve. And that translates to great results when it comes to criminal justice reform. But really, it's an asset that they get to keep and build with. And so while we're having this moment where people want to lean in and support Black communities, if we can translate that energy into political power and organizing power, we're really excited to do so.
And Xander, some quick math here. So you point out that Trump is averaging around 30 tweets per day. 900 per month, and your goal initially is getting 1 million people to give on average 2 cents per tweet, right? And then that could equate to $18 million into these organizations. Can you give us a sense of how you came to that sort of decision and what a realistic timeline is for you? Because I'm guessing all of this, of course, has to be ahead of the November election. How many people have you signed up so far? And what's your kind of big moonshot goal?
Well, we're in hour 3 over here. I'll say this. First of all, isn't that tweet number crazy? Like the guy's president of the United States, 30 tweets a day. It's an insane number. But look, our goal, we've been organizing high net worth donors to give to this strategy for a few months now. And we've been wanting to do a retail strategy as well. We know people want to participate and help get us past this terrible era we're in. But retail's hard. It's hard to figure out something that can grab people's attention and get people to lean in a bit. There's a lot of noise, and so once we kind of had this idea in the midst of this moment, we thought, okay, maybe this can happen. Maybe we can get a critical mass of people aboard and giving to this strategy. And so it was pretty easy in terms of we had already done our homework on which organizations we wanted to fund, who are some of the most effective organizations in these swing states, and we're already moving millions of dollars towards them. It was more kind of like seizing this moment. There's a group called Momentum that we partnered with that has this feature within their app. And so we decided to pull that feature out in terms of, they had a feature where you could give to the ACLU every time Trump tweeted. So we decided to pull that feature out and create a standalone brand around it. And we're having a great day so far. I mean, we're in like hour 3 over here, but we're coming up on, last I checked, we're coming up on 1,000 donors. We're giving about $175 a tweet. I hope, hopefully that hits that hockey stick chart, that we're hoping to. I know a few influencers I can't name right now, but they have a lot of followers that are yet to post today, but we'll post today. We've had great people like Olivia Wilde and Noah Centineo already lean in, a bunch of other folks. I've been not very productive in the midst of this, falling off what's going on.
Yeah. Xander, quickly, when you think about even the folks you just named, I'm a fan of Olivia, Noah, and yourself. You're 3 white people, right? When you think about the buy-in and the homework that you needed to do in order to make sure that this was going to be the right initiative, I understand you collaborated with Color of Change, but can you tell me more about how you got buy-in from the Black community?
Yes, look, I'm just here to be a bridge, right? We already have the heroes we need. They just aren't connected to all the resources. So I'm just trying to bridge to a lot of the leaders out there. We do a lot of criminal justice reform work. So we're funding a lot of these leaders already in different capacity. And so we've had these relationships for a while. I've talked to Patrisse Cullors several times this week. I've talked to Rashad Robinson several times this week. Those are collaborators that help us, think through and meet individuals. There's countless other individuals that we speak with on this front. And so So yeah, like I think in general in life, I'm here to be a bridge and just try to connect dots as best I can. We work with Movement Voter Project, who is really, really well respected. Movement Voter PAC is actually who's our grant maker in this work, and they've done a fantastic job over the years identifying the most effective community organizers that aren't usually connected to the types of resources they need to really win the elections they deserve to win.
All right, Xander Schultz with defeat by tweet. You said you got 1,000 donors so far. We'll check in with you through the fall as we get towards the election. Exciting stuff for you guys. Thanks for joining the program today.
Hey, thanks for having me on. Take care. Bye, Melody.
All right, take care. Have a great weekend. Coming up on the other side of this break, a man whose name has been in the news quite a bit recently. We'll discuss the legacy of John Maynard Keynes with Zach Carter, author of a new biography on the famous economist, and how Keynesianism perhaps fits into this current crisis moment. We'll get into all that coming up here in just 2 minutes. All right, welcome back to the final round here on Yahoo Finance. Miles Othen with you on this Friday afternoon. Well, during this crisis period, we have seen kind of a radical reimagining on the fly of what the fiscal capacity really is of the U.S. government. Now, many folks for a long time have been arguing we do have the ability to send people money, really unleash the power of the state. And a word that we often hear associated with this is Keynesianism. And joining us now to discuss all this is Zach Carter, the author of a new book, The Price of Peace, Money, Democracy, and the Life of John Maynard Keynes. And Zach, when you're writing this book, you don't think that there's going to be a pandemic with trillions of dollars of stimulus as the book is released, but certainly it would seem that this is a moment for people to reintroduce themselves, or oftentimes for the first time, understand what Keynesianism is really about. And so in your view, how does it fit into the current response we're seeing to this crisis?
Yeah, I think I'm the only person in the world, maybe, who has found the pandemic to be a stroke of great luck. The legacy of John Maynard Keynes is in many ways, I think, much bigger and more significant politically than his own life was. During his lifetime, he lost nearly every single political battle that he waged between World War I and World War II. But after World War II, he became sort of synonymous with this new way of thinking about the economy, in which deficit spending was going to be used as a sort of fiscal therapy to keep the economy from falling into recession, or to lift it out of recession if things got out of hand. And that sort of way of managing the economy was very dominant for about 20 years, but it really didn't have a whole lot to do with these big philosophical concerns that Keynes had been preoccupied with for most of his life. Keynes was sort of an accidental economist. He wasn't somebody who wanted to be remembered as a deficit theorist. His big friends when he was growing up were people like Ludwig Wittgenstein and Bertrand Russell, these major serious philosophers from the Cambridge philosophy department. He wanted to be seen as somebody who was grappling with the big social problems of his day, which in his time were war and then also depression. So he became sort of an economist by accident. And in many ways, I think the economics profession's sort of legacy that they built around him misses out on that broader social vision. So I feel like when we look at the coronavirus pandemic and resulting crash that we've had over the last few months, Keynes would not be somebody who would be talking about how big the deficit should be or how small it should be or what sort of fiscal space we have. He'd be looking at the social problem and saying, okay, what do we need to do to address what's going on culturally? And then how do I reverse engineer an economic solution from that point that will be politically palatable or tolerable to the society at large?
Yeah, and obviously he comes at it from a different perspective, but I am reminded of Jay Powell spending a lot of time talking about the unequal distribution of the impacts of this crisis, and saying the phrase he's used a lot is those least able to bear the burden of this are bearing the brunt of it. And so thinking about the economics profession, is Keynes perhaps a reminder that they should be less economics-y and not stop pretending to be physicists and maybe look at it more like sociologists instead?
Well, Keynes was very critical of the sort of mathematization of the profession that went on. It began during his lifetime, but really accelerated afterwards. He couldn't, of course, be critical of it after he had died, but this was not a direction that he wanted the profession to go in. He recognized that a lot of what he was doing was taking an idea and dressing it up in mathematics in order to make it, appeal to people who were very good at math. I think in the present moment, he's somebody who was very concerned about inequality itself, not just as a sort of mathematical relationship, but as a sort of social glue that societies that were deeply unequal would not be able to hold together. They'd be subject to a lot of upheaval. And he was worried about inequality for a very conservative kind of reason. He liked all of these nice things about being a fairly fancy guy in the heyday of the British Empire. He liked drinking champagne with Virginia Woolf and talking about what was going on at Pablo Picasso's studio at Montparnasse. He didn't want to lose that stuff because the rabble were sort of getting furious and rising up.
Right.
So he was trying to devise economic policies that would sort of bring society closer together, not just because he thought that would result in more growth or a higher employment rate, but because he was worried about society breaking down, about people within society sort of being at odds with each other. He was worried about disharmony a lot more than he was worried about growth. So exactly. I think today that's something he'd be talking about quite a bit.
Sorry, I just didn't want to interrupt there, but I did want to ask, all of these things are very interesting because it seems like, these were discussions back in the 30s when he was working with FDR, for example, but very relevant to what we're facing right now with regards to the COVID-19 crisis. But I did also want to point out, also during this time of discussion about MMT, modern monetary theory, which is almost the next natural evolution with respect to how policymakers should be approaching deficits. Do you think that a lot of the battles that he faced are very similar to the battles and the discussions now about how people are thinking about deficits and government spending?
Yeah, I don't want to put words in the mouths of the MMT people because I often find myself in agreement with them on some basic points, but they also sometimes kind of lose me. I don't totally fully understand the intricacies of the Federal Reserve operations they talk about sometimes. So I don't want to say that I'm speaking for the MMT folks, but when people like Stephanie Kelton or Nathan Tankus talk about economics and economic policy making, they're talking about the actual capacity of society to mobilize real resources. So, how much wheat and how many sheep we have and how many workers we have. Right. That's what they're focused on. Keynes was always focused on that problem as well, because he kind of came to economics from the position of this imperial manager. He was working in the Treasury Department in World War I, really managing the entire British wartime economy. And he knew, okay, we need to get wheat for a certain price. We need to get people. Is it more effective to have more soldiers or to have more factory workers making munitions? He was making these decisions in real time. And I think that's the way he looked at how to solve problems. Not, do we have fiscal space in the sense of debt and deficits? And I think the MMT people are on the same page with him in that sense.
All right. The book is The Price of Peace, Money, Democracy, and the Life of John Maynard Keynes. Zach Carter, thanks so much for joining the program. We'll talk to you soon.
Thanks, guys. Great to see you.
All right, coming up on the other side of this, watch the market selling off as we head towards the closing bell. We're back here in just 2 minutes. All right, the Dow off some 700 points as we head towards the closing bell. We're going to be back with that live from the floor of the New York Stock Exchange in just 2 minutes.
Welcome back to the final round. That is the closing bell for this Friday, for this week. It is red across the board here. The Dow is going to end off some 700 points. S&P 500 and NASDAQ both down more than 2% as well. Russell is also down around 2%, but is the best performer out of the bunch there. We've got the VIX moving to the upside today. Of course, reopening, kind of getting stalled. These coronavirus cases, the numbers are not looking good. So we are back into that phase that, Miles, I kind of feel like we were in before, where the market is trending with the numbers that we're getting on coronavirus. It's like I kind of get this sense that I've seen this movie before. We kept talking about the V-shaped recovery. Do we now bring back talking about, is it a W? Do we have any sense of, can we decipher what's happening yet, or is it just way too early? Is Miles there?
Look, yeah, I'm here. The shape never really mattered, and I don't think it does matter now. I think, as we saw with University of Michigan consumer sentiment this morning, if people are afraid to go outside, they don't go outside. Consumer sentiment goes down when the virus goes up. And so you're right. We have seen this movie before. We know more about how the market will respond and so forth. But ultimately, the economy is going to do worse, and there's no what the market is taking now. How long this corrective phase lasts, who knows? But certainly the situation has changed dramatically in the last couple of weeks.
Rick Newman talking about some of the changing situations here. I mean, it's a pretty fast-moving situation that we are going through. But as you know, Howard Marks, Oak Tree chairman, likes to say, history doesn't repeat, but it rhymes. And I think investors, a lot of people have been kicking themselves for missing the bottom the last time. What's the thought process right now for people in terms of a possible downdraft? Because we've also been told we've got so much cash sitting on the sidelines for people that didn't get to get in the lows of March and April before. Oh, hey, Rick, you're muted.
I'm sorry, guys. It's Friday. I mean, everybody's doing this. The Friday mute problem. Obviously, markets aren't sure what to make of the uptick of cases in the South and the, I guess you could call them partial reclosings now. The Fed could just solve the market's whole problem by buying, I don't know, more bonds on Monday, or buying more equities, or whatever the Fed's going to do to ride to the latest rescue. But I mean, I've been a skeptic on our air for the last 2 months, wondering what reality investors are looking at, if they're looking at anything at all other than the Federal Reserve, because there are two different types of lockdowns. There are the ones imposed by governors, and then there are the ones that consumers impose on themselves. And I think that second one is hard to measure, but it's very real, and we're seeing it in some spending data and things like that. So you're hearing one of the takes on what's happening in the South is, oh, these are younger people. They're healthier. They're not going to be hurt as bad. They're not going to overrun hospitals as bad. But I'm actually not so sure about that. I mean, young people can still affect older people. And we're seeing some really high numbers of cases here. So in 3 or 4 weeks, this could look even uglier than it does now, as death rates actually go up and hospitalizations too.
We're going to dive into some of those numbers coming up with Anjali Kamlani. But first, I want to get some more details on the sell-off today and bring in Jared Blickery. So, Jared, we also had rebalancing on the Russell on the close. Do we see any action there? What can that do for us?
Well, that really doesn't affect the entire market. It's kind of particular to individual stocks. They can have some movement. And I didn't see that much movement in the indices at the end of the day. Let's take a look at the week's price action on the Dow here. You can see finished at the lows of the week. I guess the upshot is it could have been worse. I mean, you look at the S&P 500, same story here. It took out the week lows. But since the market high, the FOMC high 14 days ago, still haven't breached these lows here. That was after June 11th, that huge 5% down day, and then the day after. So kind of testing the support area here. And I don't know if Rick was kidding. Well, I think he was kidding when he said the Fed could step in Monday. But I was reading some of that very speculation today on Twitter, and there's always lots of speculation on Twitter. So we take that with a grain of salt. But I would say the Federal Reserve has slowed their asset purchases, and their balance sheet has now shrunk 2 weeks in a row. The reason it's shrinking is because the Fed isn't lending as many dollars to other central banks because they don't need them as much. So that's a good thing. But its QE is kind of anemic right now. And it is possible, theoretically, that the Fed could simply step in and up its purchases next week. It is committed to open QE. So we're taking a look at the 10-year T-note yield here. Let's take a look at the 2-month. We dropped below that 65 basis point support, and we've been talking about that a lot. It has consequences for the equity markets. We could get a false breakdown, and if we go back up, pop back up next week, that would be a welcome sign for the markets. Do not want to head down here. But let's take a look at what's happened this week in the major indices. So we got the NASDAQ 100 heat map, and we're going to go to 5-day performance, and we can see some green here. That's a little bit encouraging, but look at the declines. Facebook off 9.5%, a lot of that today. Alphabet off 4%. And just sorting by the big winners and losers, a defensive setup overall. NetEase up 6, Zoom up 5, eBay up 5, Splunk up 5, and then some COVID plays in the retail space like Dollar Tree up 4. But travel names, United is getting hit by 10% this week, Ulta down 10%, Ross down 10%, Marriott almost 10%. So it just kind of goes on like that. And then just looking at the software names, those have been a source of strength. So we're seeing some outperformers here. Microsoft, the perennial winner, is up 0.6%, Workday up 2%, but these guys not necessarily carrying the water. When you have a general market slowdown or sell-off, usually the leading members will sell off less. So these names I'm paying attention to see which ones hold their support, hold their moving averages. And there are some standouts as well in the cloud space, like DocuSign up 10% over the last 5 days this week. And then we also have Coupa Software. That's up 6.5%. But just broad-based weakness here. We'll have to see if it carries into next week, and maybe we'll get that mythical Fed put.
So the broad-based weakness, of course, Jared, thank you very much, tied very closely to the rising case counts that we're seeing and the reopening plans being shelved or stalled in certain areas. Looks like San Francisco is going to be pushing back on theirs. We've heard about some news out of Texas and Florida. I want to bring in Anjali Kamlani for the very latest. And Anjali, today, just talking about muscle memory, the task force was back. Did we learn anything from there? Any headlines out of having them back in action?
Yeah, Jen. So definitely just hearing from them, right? Just what they've been working on kind of reaffirms what a number of them, which have been out in the media, have said. We know Dr. Fauci has repeatedly said that the focus of the task force right now has been state reopenings. And I think that was one of the biggest takeaways. But also he emphasized the fact that while we are seeing concerning surges in the South and in southern states as well as California, one of the bigger concerns is that if this new resurgence is not hampered, if it just continues to go on, it could result in danger for the other states, including New Jersey and New York, which had already recovered. And so that is one of the bigger takeaways from today. Meanwhile, also just an emphasis on what the administration is doing in terms of cooperation with some of the pharmaceutical companies and what kinds of drugs and treatments are being researched. That was something that Health Secretary Alex Azar touched on. And then Vice President Pence definitely had a message of we're much better off than we were before. And things are, much better now countrywide in terms of the trends of cases. But meanwhile, we are seeing, those concerning cases. He mentioned 34 states are doing pretty well. But meanwhile, those larger cases that are of concern, Texas and Florida, as you've mentioned, really with those concerns of hospitalizations, the younger age group being a large portion of it, and not knowing what that result will be in terms of the death rate in the future, whether or not we will see an uptick 2 weeks from now as a result of these hospitalizations. So all pretty concerning overall, but also just a wait and see. Once again, going back to what you said earlier, we've seen this movie before, we saw it play out, and we've seen a lot of health experts sort of point to not following sort of the same strategy that was employed here in the Northeast.
Anjali, you've been on this beat for us the whole time, and I'm just curious this week in talking to your sources and people that you're interviewing, does it seem that they are calmer, more optimistic about this wave or these hotspots, whatever we're seeing now? As the vice president pointed out, we have learned, we know a little bit more about it. And do you feel that with the medical professionals that you're talking to, that they agree with that sense that we're not necessarily doomed to repeat what happened in New York?
The concern still remains hospital capacity. I think for the large part, will there be enough medical professionals on top of medical supplies to help address the situation? I think by and large, we've seen that some of the immediate concerns that New York City specifically struggled with, whether it came to access to supplies, to testing, personal protective equipment we saw was a major one. And so while those fears have been largely allayed, as well as ventilators, because of the federal action, maybe those concerns aren't as immediate. But when it comes to the simple fact that there is no blockbuster treatment, there is no way to really help a patient who gets to that severe point recover, I think that is still the major concern, is that hospitals will have to deal with that, and medical professionals are still dealing with that.
Anjali Kamlani with the very latest. Have a great weekend. Thank you so much. Back to the market right now. We're going to talk about the biggest winner for the S&P 500 today, and it was Gap. Yes, Gap. That old store that old stock that we just kicked around for so long, just to the curb. I mean, Rick, nobody liked it. You couldn't figure out what was going on there. They had so many stores, but now they're being saved by Kanye West. Yeezy Gap. Are you going to head there? What do you make of this tie-up in here? First of all, did you even know that Kanye West had worked at the Gap?
I did not know.
Yeah.
And he's making a 10-year deal with the Gap. I think there are a lot of people who aren't even sure the Gap is going to be around in 10 years. I mean, if you ask Brian Sazi about the Gap, his head would practically explode. So this is a 10-year deal for relatively inexpensive clothing for men, hip wear for men, I guess. I asked my 21-year-old son about this deal because he usually knows about this kind of stuff before I do, and I was interested to get his take. He hadn't heard of it, and I can guarantee you he has never been in a Gap store, and I don't know if it's going to get him into one. He does love the Yeezy shoes, I know that. So I guess the question for Gap, I don't even know who the Gap customer is anymore. It's like the most bland slice of America, middle America you can think of. So they're trying to revive their image. They think he can bring them $1 billion in annual sales in the future. That would be like a 20% increase for them. So very ambitious for Gap. I guess Kanye West probably is going to be able to run the show here because they probably need him more than he needs them.
Well, and to that point, Rick, you say, what does the Gap stand for? Well, I think people do know what the Yeezy aesthetic stands for. And some people might think that the kind of the clay and bone colors that you find most of their gear in, that doesn't appeal to everybody. But to your point, the Gap means nothing. So if it means that, that's a positive for the company, and the market certainly agrees.
So Miles, I'm over the hill. I'm not the target customer here, but you arguably are the target customer. Are you going to go to the Gap and check this stuff out?
Bad news for me, Rick. I am not the target customer. This is not about 30-year-olds. This is about teenagers. This is about Jen's children. That's the focus group here. It's not me. I'm old now.
I do not.
You can pretend you're still a teenager.
No, Miles is
Rick,
not.
I'm wearing a golf shirt on the internet. I'm not cool or interested. It's all over, man.
Good chance for you to youthen your image.
Can I raise a serious question about this deal? And I think it's I think it's some good thinking. Gap needs a real shot in the arm. He could definitely be the one to do it. He has, from time to time, stepped into different controversies. And in this time right now of cancel culture and everything else going on, do we need to worry about, Gap getting, you have no idea what Kanye could say from day to day at all.
He has praised President Trump, among other things. But if you're Gap, Gap is struggling so bad that the old saying probably really is true, that there's no such thing as bad publicity. I mean, anything that enlivens Gap image, even if it's negative at this point. I mean, I guess you can see, I'm sure there's a clause in this contract that says Gap has a right to sever the relationship if he does something completely outrageous. But I kind of don't see what Gap has to lose here, honestly.
All right.
I agree.
Nothing to lose. When you're so far down and out, the only way you can go is up. And today, Gap was up a lot. Again, the biggest performer in the S&P, up more than 16%. We're going to take a quick break. When we return, have technology stocks gotten too far ahead of themselves? We're going to discuss whether it makes sense to take some profits on those FANG names. Is that what people were doing today? That's coming up right after this. Some big losses. Facebook, you know the story there going on with advertisers and the boycott. Facebook off some 8%. Google, though, off about 5.5%. Apple off 3%. Microsoft and Amazon both off some 2%. I want to bring in Tobias Carlisle right now. He's the founder and portfolio manager at the Acquirers Fund. And, you know, we always love to talk with you about some big tech names because look, everybody's in them and everybody wants to know what they're supposed to do because here they've ridden this up and now people aren't sure whether it's time to take some profits. As you look at the action that we are seeing specifically today and a little bit this week, given what we have on the reopening of the economy and the increasing number of cases, how do you think people should be thinking about the FANG names right now?
I think FANG's extremely expensive as a group. I always think it's funny that Netflix gets included in there with them because Netflix has got monstrous negative free cash flow, whereas the other ones are generate plenty of free cash flow. It's a funny market. It seems to be completely disconnected from the fundamentals. I saw Google got really badly beaten up today when I think of all of the FANG names, Google's one of the better stocks out there. Facebook's got specific problems, but there's clearly some aversion to those stocks because they all do seem to be extremely expensive. The underlying businesses are phenomenal, though Netflix excluded because they all seem to be growing very rapidly, throwing off plenty of free cash flow, unimpacted by coronavirus, it seems. So it's very hard to be long or short any of those names, I think. But for the most part, they're probably going to keep on going.
Talk to me a little bit about Intel. Is it you have added an Intel position?
So we recently put Intel into the fund. Intel's a phenomenal business, massive returns on capital, sort of in the order of 50%, and a dominant position in that chip maker market. But it's getting beaten up because Apple has severed ties. The impact on Intel is going to be fairly small. It's $3 billion out of $70 billion in revs. So I think that, and it's going to take several years for that impact to be felt, but it's still a phenomenal business growing very rapidly. And you can buy it today at 10 times EV EBIT, 7 times EV EBITDA. I think it's one of those things that, given a few years, it'll be perfectly fine once it works through these sort of near-term narrative problems.
And Toby, thinking about the market more broadly right now, there's a lot going on, I guess we could say. But when you think about the rotation, there's been a couple of rotation events. Value has picked up some ground at some points. What are you seeing in terms of those flows and opportunities that are interesting to you? Kind of given the market that, VIX closing at 38 today appears to be entering another quite turbulent phase.
Yeah, very, very confusing market. Value had a really nice run. Momentum was getting crushed for a few weeks, maybe in June, and then that's reversed very, very violently. And now the spread is as wide as it has been at any point over the last sort of 5 years. Value at some stage, I think, becomes an incredible opportunity, but the trend continues until it ends. And so your guess is as good as mine as to when that actually happens. It's probably going to require, as it has in the past, some sort of big drawdown in the market and a rebasing of all of the valuations in the market. And I think that probably happens sometime as a result of this current market weakness. I don't know when that happens, though.
All right. So you said anybody's guess, and you don't know when it happens. But I want a little bit more on the value play and what we need to be looking for, at least. If we can't, I know we can't call exactly when it's going to happen, but what the character of it will be that you'll feel that confident in making a move in value.
I would say that the undervalued portfolios right now are as high quality as they have been for a very, very long period of time. The names like Berkshire, Markel, Intel, very high cash flow generative, superb balance sheets, very solid businesses tending to fall into that market. It's become a market that's increasingly concentrated on those FANG names and the high growth names, and the market's paying extraordinarily high prices for that growth. And that's something that we've seen at previous market peaks. That's something that tends to be pretty unstable. I think that there've been so many false starts for value. You'd be absolutely mad to try to say that any one of these little runs for value is the real one. But I kind of think that it's so stretched now. When AQR, Cliff Asness has produced a number of superb papers for AQR. Most recently is Systematic Value Investing Dead. He's saying that the spread now is at the 100th percentile, which means that it's broader now than it was at the dot-com peak. I think it's hard to know when, but you'd be mad to try and bet against it.
Lots of false starts, but I guess eventually going to get it. Tobias Carlisle, really good to see you. Have a great weekend. Again, Toby's with the Acquirers Fund, the founder and PM there. Thanks so much.
Thank you.
Coming up next, we are grading the week that was for, you guessed it, President Trump. Your Trumpometer score in 2 minutes. Well, welcome back to the final round. Another busy week for the president. How did he do? Rick Newman's been tallying it all up, and he has your Trumpometer score. Rick.
Jen, here's a story this week. It was the week that Joe Biden officially became the favorite in the presidential race, which means President Trump is officially the underdog, underscored by a new New York Times poll that has Biden ahead of Trump by 14 percentage points nationally, and ahead by between 6 and 11 points in the 6 swing states that are going to make all the difference. For anybody who's wondering, yes, that is a bigger lead than Hillary Clinton had over Trump in 2016, and Biden is doing better than Hillary Clinton in some other ways. So if you're a Joe Biden fan or a Democrat, I guess you think that's good news, but it's in a way not good news. The whole reason Trump is crumbling in the campaign is that the country is doing horribly. I mean, we are losing to the coronavirus at the moment. Cases are going up. The death forecast has now gone from around 60,000 2 months ago. The forecast is now for 200,000 deaths by October 1st. So, and of course, the economy is just muddling along at best. So the Trumponomics score this week is as low as it goes, I'm sorry to say. Sad.
Didn't you add nasty at one point, even lower?
Yeah, we had, it was so bad that one week when we had whatever it was. Yeah, the unbelievable number of unemployment claims that we had to go create an unofficial layer worse than sad, which is nasty. But there's only been one nasty so far. There could be more. I mean, Trump's going to get desperate if he continues to do as badly as he's doing in the election. So as bad as it is, it could get worse. And I'm the guy to bring you all the bad news.
Thanks so much for leaving us on that down note. But
now you can go have a beer in the beautiful warm weather like I'm going to do in about.
It's your job. Have a great weekend. I'm not going to go do that yet because coming up next is our latest weekly special. Let's get real. Is it time to buy or sell? We are talking all about the biggest trends in real estate right now and how the industry is changing in the post-coronavirus world. That's coming up next. Welcome to Yahoo Finance's latest weekly special. Let's get real. Is it time to buy or sell? The housing recovery is in full swing. New home sales data posted this week showed a 16.6% gain in May over April. Mortgage applications are 18% higher than they were a year ago. So where does real estate go from here, and how is the industry adapting to a COVID world? Let's bring in our first guest, Spencer Raskoff. He's an entrepreneur. He co-founded Zillow. He served as the company's CEO for a decade. He's now an active angel investor in over 50 companies and serves as executive chairman of LA. So Spencer, real estate, I mean, I think it just ground to a complete halt. I think a lot of people have been surprised at how quickly it's come back. Is that something that we're seeing across the country? Like, how big of a V trajectory is this, do you think?
It has bounced back incredibly quickly, I think more quickly than anyone thought. So just to throw some numbers at you, listing page views are up 50% year over year on for sale homes on Zillow, for example. So there's tons of interest in buying homes. Now, transaction volumes are still down a little bit. It's going to take a couple more months to get fully back to normal. But people were cooped up for a couple of months. Interest rates are historically low, and home shopping is in full swing.
So when you go home shopping these days, it's different. I mean, look, so open houses have been able to start up, but there were the virtual open houses. And we've talked before when we had you at our On Market Summit a while back, just about where is real estate going? Is it going to be like you can point and click and buy a house? And we're seeing these huge technological shifts. Do you think that we're getting closer to that? Is this time of advancement making big strides in real estate, as well as what we're seeing and how we're all working from home?
Yeah, look, COVID has accelerated a lot of trends across our economy that were already underway. So food delivery, grocery delivery, streaming, growth of streaming services at the expense of movie going. These trends have been in place for 5 or more years, and then COVID has dramatically accelerated it. That's what we're seeing in real estate too. So things like virtual tours, transaction management that's entirely online, online mortgage origination, 3D home listings. These things have been around for the last couple of years, but we're now seeing a big acceleration in those trends as a result of coronavirus. So I think, that is a good thing, in my opinion. Most of those innovations that have come to real estate are long overdue. And if anything good can come out of this pandemic, it should be and could be an acceleration of these tech trends, which I think are great for the consumer and for the industry.
And Spencer, another trend that everyone wants to say is happening is folks like me, millennials growing up, leaving cities, going to the suburbs. As far as what we've seen so far, does that seem real to you? Because it's been a burgeoning trend for a while, but is this really the time it's going to happen?
Yeah, so the media is talking a lot about this, right? And the short answer is it's a little too early to know whether this is real or this is people just extrapolating anecdotes. So there are two types of relocations that I think about here. One is people staying in the same metro area, but leaving a city center to move, say, 30, 60 minutes away. So as a result of work from home, if I don't have to be in my office every day, I can be there 1 or 2 days a week. Well, maybe I can live in Calabasas, not Santa Monica. Maybe I can live in, upstate New York, not in Manhattan. Okay, so that's one trend. The other is people just picking up all together and saying, I don't want to live in the city anymore. I don't want to live in New York. I want to go live in Boulder because I can remote work all the time. That first trend, I think, is real. I think that work from home is real and permanent, and you're going to see people contributing to this kind of suburban sprawl, 30, 60, maybe 90 minutes away from city center and just commuting into the office maybe 1 or 2 days a week. I'm very skeptical of the second trend. I think people are talking a lot about it. Hey, I can go live anywhere. Why not move to Hawaii? I've always thought about moving to Hawaii. I don't think I don't have data yet, but I'm pretty skeptical of that one.
And then to kind of follow up on that first point, I've noticed it in my apartment. Obviously, we didn't plan to work from home in 600 square feet, but I feel like in every home, you now need to think about what would it be like if I'm here all the time instead of just some of the time. How do you think that might change expectations, not just square footage, but like, oh, this appliance needs to be nicer or the chairs need to be comfortable, stuff like this?
Oh yeah, so this is a trend that home builders are already trying to wrap their mind around, home builders and remodelers. I have a beautiful home office. I don't have a door on my home office, because this is a very like open floor plan-y kind of house. That never bothered me before. It was great, pre-quarantine, that the kids could just kind of come in and in and out as they see fit. Well, I would kill for a door now. I'm seeing home designs now where people are building out kind of like audio pods, where there's really good sound, almost like a sound booth for taking calls and doing video conferences. I mean, whoever thought they would be building things like that into their house? So we're definitely going to see some different home building trends as a result of work from home from post-COVID.
Yeah, I think some of them are calling them Zoom rooms. I want to get one.
I do too.
And they have doors. Okay, so do you think there's going to be consolidation in real estate? I guess we've been seeing that with a lot of agencies already. Is the industry going to go through changes aside from just the technological ones? And then is that going to ever impact the brokers in any way, and the fees that we all pay?
Oh, the fees. We always end up on the fees. So let's see. The relationship between the agent and the brokerage has changed a lot over the past 5 or 10 years. So agents used to get a lot of things from their brokerage. They would get office space, they'd get branding, they'd get lead generation, they'd get software tools. And over the last 5 or 10 years, a lot of those services are no longer provided by the brokerage exclusively. They're now provided by sites like Zillow or Facebook advertising or coaching, where a lot of real estate agents hire their own personal coach. And so that relationship between the agent and broker has changed a lot. And the split, in other words, how much of the commission the agent keeps at the expense of the brokerage, that has changed quite a bit in favor of the agent. And that is starting to drive consolidation among brokerages as well. Totally separate from that, there's the fee that the consumer pays, right? The 6%, which is much higher than it is in other countries, where it's typically 1 to 3%. And I haven't seen that change very much. And the reason for that is that most transactions in the US still have 2 agents in the transaction, whereas in other countries, there's just usually 1 agent. In the US, there's buy side and sell side representation. And so that commission has stayed pretty steady in the 5 to 6% range, despite the growth of technology. But don't think that there isn't a lot of disruption happening in the real estate industry. There's plenty of disruption in terms of which agents are successful, how much of the commission they keep from the brokerage, how consumers are empowered, and now increasingly what types of technology tools these consumers are using when they actually home shop and buy. And so much of that is becoming more digitized as a result of coronavirus.
And before we go, I want to ask you about .la, because you're out there. It's a new project that you have going on. And look, we're in New York, and we cover the whole country, but we're more intimately familiar with what's happening with the economy here. We've had a ton of guests though before COVID hit out of LA. The startup scene was really hot. What are you seeing in terms of the economy in LA right now? Is it still a hotbed for entrepreneurship, or has that cooled?
No, LA is on fire, and that's why we started .la, to try to shine a light on all the innovation and all the technology startups that are doing great things here. I mean, in LA now, we have a robust founder and angel investor scene. We have incubators, we have venture funds, we have late stage venture funds. We have unicorns, companies like SpaceX and Service Titan and Relativity Space, ZipRecruiter, Headspace. We've got big public companies like Snap and Cornerstone On Demand. And then many of the major Silicon Valley companies now are in LA in a big way, whether it's Facebook or Google, or of course Netflix, which is for all practical purposes now headquartered in Los Angeles. So LA is happening in a huge way. And that's what .la is trying to do, is to tell the stories of these companies that are growing so quickly in Los Angeles.
All right, Spencer Raskoff, he is the executive chairman of .la. He is one of the co-founders of Zillow, and of course was the CEO there for a decade. Thanks so much for talking to us about what's happening in real estate right now. Have a great weekend.
Thank you, you too.
Coming up, which properties are languishing and which are seeing bidding wars? We talk to the CEO of Brown Harris Stevens next. Welcome back to Let's Get Real. Is it time to buy or sell? Bess Friedman is the CEO of Brown Harris Stevens. Over 2,500 agents at that firm, and she joins us now. So you really have your finger on the pulse of what's happening, especially in New York. So let's start with this bidding war idea that we keep reading about and hearing there are bidding wars. What properties are you seeing the most demand for right now?
Are we? You're talking about specifically in New York City?
Yeah, either New York City or the suburbs. I mean, real like any in your wheelhouse, what you guys are seeing. Where are you seeing the most people come in and all be wanting the same property?
So other regions, I'll just tell you where there are multiple bids and there's undersupply would be places like Palm Beach, Connecticut, the Hamptons. Those areas there's just not enough product and there's multiple bids happening in all of those regions. Here in New York City, because we just opened up to be able to show starting this week, we're just in phase 2. It's hard to say. Although, so the agents that I've been speaking to have been telling me that the sweet spot is the $1 million, around $1 million, 1 to 2. People are bidding and interested, but they're telling me that the over $3 million market has been very quiet.
Okay, so let's talk about New York and the quiet parts, because everybody wants a deal, and a bunch of us live in New York. So are prices going down? Are there any screaming deals in New York City right now?
Well,
and if not, when are they coming?
Yeah, good question. Well, I think, remember, prior to this pandemic, we were already in a price correction and the market was correcting and we were very fluid in doing business. Then the pandemic hit. So I would say this is a huge opportunity market for all buyers who are interested. And I think for new developments, they can find incredible deals. And I think that rates are really good. So I think the prices are continuing to correct and that sellers have to be realistic and let go of pre-pandemic pricing and understand that we're kind of in a new arena.
And then Bess, thinking about that, does it seem to you like the next 18 months may be even more challenging than right now because we're also in a recession? So we had this weird housing period, but I don't think the prospects for the economy are necessarily rosy looking out over the last couple of years. And as you mentioned, the New York City market specifically had already been in a kind of a tough spot.
Yeah, I mean, you make a really great point. I think we are really concerned because we've been facing these headwinds regarding taxes anyway. The cap on the SALT deduction, we had the mansion tax, and then all these, in Albany, there's all this legislation pending, like a pied-à-terre tax. So a lot of New Yorkers have packed up and left. They have moved to Florida or different, states. And that's been an issue. Now the pandemic, so vertical living offers other challenges. And then, as you mentioned, unemployment, the economy, and it's also an election year. So all of those things that you just pointed out to me, yes, I am concerned about the market. I know New York is very resilient, but I'm also realistic. And I think that the market will be slow and steady. But I think we have some challenges. We definitely have some challenges.
And then I'm also curious about the rental market, both for apartments and homes as well. I think there's this weird feeling of people want to be in the suburbs maybe for the next year, maybe not forever. And I don't know if there's really the kind of supply for medium-term rentals that seems to me has grown up, or the demand has grown up for that quite quickly in the last couple of months.
Yeah, I mean, the rental market, interestingly, in New York City, I was speaking to a colleague who is at a different firm who knows everything about who's involved with rentals. And the supply for rentals is overwhelming. You can literally pick and choose, and landlords are being very flexible. They're, offering a month or 2 months free. So I think if you're interested in renting, now would be a great time to do that as well. So.
Let's talk about the international buyer in New York, because for many years they were seen as helping drive a lot of sales. Are they coming back at all? Are you seeing that, or do they? Because in some ways, is New York a good place to be? I mean, the numbers are okay. You've got great hospitals, or do you not want to come to New York at all? What are you seeing there?
I think right now, I mean, it had been a little bit sketchy for a while, and I don't know it's right now, it's too soon to know. I think it's going to take some time because we have some real challenges. We're not seeing this rush of international buyers, that's for sure. We're going to have to see what the upcoming months show us. I don't really know. I have to tell you that I don't know what's going to be in that regard.
Well, Bess, you're not alone. We are saying constantly on the show that we don't know, and we talk about the stock market. People expect us to know about that. So
but also the stock market is, Wall Street is not Main Street. We have to understand that that's not a reflection of what's going on in the United States today. There are so many people unemployed. There are people that are sick. We have COVID. We have a lot of things going on, a lot of angst. And anybody who says that they know is really, we're all spectators. That saying that there's two kinds of spectators, people who don't know and people who don't know they don't know. Mm-hmm. And I think most of us just don't know. But I remain incredibly optimistic about New York City because I love it here. I'm raising children here. And I'm hopeful that we're going to be able to get through this. I know Miles is a little more skeptical than me.
You just met him and you can already tell.
I can tell, Miles.
He's optimistic. He maybe he just didn't come across. Bess Friedman, have a great weekend. Thank you so much.
Thank you, guys. Be safe and
telling us what you're seeing. Great to get a chance to talk with you.
Thank
you
so
as you just heard from Bess, people have been leaving New York. Where are they going? Well, they're calling it New Florida because of all the families moving from New York and New Jersey. We're going to talk to a real estate developer from the Sunshine State next. Welcome back to our special here. Let's get real. Is it time to buy or sell? So the number of sales contracts for Manhattan co-ops, they fell 80% last month compared with a year earlier. This is according to a report from Miller Samuel and Douglas Elliman. But let's contrast that with what is going on in Southern Florida, which saw a big bump in May, especially for standalone homes. I want to bring in Jules Trump. He's a real estate developer near Miami. He is the Trump Group co-founder. And Jules, before you go, I'm sure you're used to this by now, but you are not related to President Trump. You're your own Trump.
No,
okay?
we're very separate.
So we got that out of the way.
Very
Tell me
separate.
what you're seeing. You're obviously in a beautiful spot. You deal in the luxury market.
Right. We're at the top end of the luxury market in Miami.
How is it? How is it at the top end with at those rarefied prices? Is anyone buying right now?
Well, look, we've recently started our we're part of Aquilina. Aquilina we started with a hotel with them and then added condos and added a second condo building. And now we embarked on a 245 unit additional condo, 2 towers called the Estates at Aquilina. And at this point, our first tower is pretty much sold out. In January, we started building and launched sales of our second tower, which consists of 94 residences, all large, all corner residences. And we're about 20% sold in the 2 months, January, February. So we experienced strong demand. When the lockdown hit, nothing. I mean, it went, really cold, and understandably, because what we sell here is lifestyle, and because it's a combined hotel, resort style living, and but many primary homeowners.
Yeah.
So went completely dead at that point. We reopened 9 days ago, and quite successfully. We have several contracts that we're now negotiating. So, we feel that overall the demand is certainly there. I heard a little earlier Miles making some remark about how many people are leaving the Northeast, and obviously Florida is the biggest beneficiary of that.
Yeah. And Jules, you mentioned the lifestyle down there where it's people, it's mingling. You want to be part of the community. How do you see that changing over not just the next 6 months? Does this change how people think about the Aquilina properties longer term?
I don't think so. I mean, I think we're fortunate in that we built out in a concept with lots of space. We've got 12 acres here. We've got 1,200 feet on the beach, and it affords us tremendous flexibility. So we haven't packed the property. We could have done twice as much development on this property, and we didn't. We believe in larger residences and large amounts of space for the residents. So we're not experiencing that. Also, there are lots of spaces that people can be private. So, you take even a place like, I'm sitting at the pool here, and, as you can see, there's not a lot of people around. There's, I guess, a couple of families, but that's it.
Are you having to change any of your layouts, or do you think that you will be in the future? We were just talking with the co-founder of Zillow, and he was talking about people wanting rooms where they can take phone calls from. People
absolutely
want to have more home offices. People want to have places for their kids to go to school. So will you be adapting your layouts to accommodate this?
Jen, that's a great question. Look, we fortunately in our newest tower, we built it all 4 and 5 bedroom residences. So now what we're doing is we're showing examples of how you can build it out as an office, and we're actually doing it for the buyer. We'll build one of the rooms out as an office, and we hadn't thought in terms of a homeschooling office, but obviously that can be adapted. And we focus heavily on families, so that's probably an idea that we need to follow up on. Look, we're learning as we go, because it's a different world. I mean, we did surveys, and we found, there were 4 basic things that seem to be apparent. The one is people really are rethinking their lives. The second thing is home and family have become absolutely cardinal to people. It's much more important than it was before. Then the feeling of security and being in familiar surroundings and so on, the feeling of safety has become much more important. And then obviously, to Miles's point about people moving from the Northeast, this is simply accelerated. It has started 2 years ago, and it's certainly accelerating at this point.
Jules Trump down there at Aquilina, thank you so much for giving us a little insight into your business as we talk about people moving from the Northeast. It does look nice down there right now. Yes.
you, Jen.
Look,
Thank
I
you.
am looking at the cases though, and that makes me a little nervous, but you got a pretty
Yeah.
shot there.
Yeah.
Jules Trump, great to get a chance to talk with you.
Thank you very much. Thanks, Jen. Thanks, Miles.
So, Miles, what have we learned here? I think that real estate, like every other industry, is seeing great changes, and there's still a lot of questions left out there.
Yeah, I think what's interesting, thinking about it as a millennial, we can only be ourselves. I think the parts of the market that are attractive to myself and my peers, apparently that's where all the demand is. So I think a challenged generation, once again, finds challenges as they think about real estate and their next steps.
Always woe is me with the millennials.
I'm just saying, we had someone say starter homes in this area, like there's so much demand for this. And I feel like I was thinking about leaving the city and everyone's thinking about it at the same time too. So
No, I'm just teasing
there
you.
you go.
You're totally
That's
right.
fine.
Have a great weekend, everybody. Thanks so much for watching. We'll see you on Monday.